And we're off. Let's see what we got going. Oh, that looks like we got some lower movement on the SPY. All right, J Powell, got to close you out. Ooh, look at that. So we've got a 15-ish point drop on the E-minis. That's not too bad. I'm not worried about that. We had some bearish sentiment on Friday. I mean, obviously, look at this drop. This was insane. So this was caused by good old-fashioned J Powell at the Jackson Hole meeting. It's been an interesting 2 weeks. Look at this downward movement we've got going on right now. This is awesome. So we need to shake the weak hands out of the market a little bit more than we have. So we had a little bit of a bull run. There's been bullishness ever since the end of the Fed meeting when everything came in line with what we thought. The 75 basis point rate hike was exactly what the market wanted. What they said about quantitative tightening was also what the market sort of wanted, I guess. But we have a little issue with quantitative tightening. I'm actually going to talk about that a little bit later. But right now, we're looking at the futures. We've got some downward movement on pretty much everything. Let's see, this S&P is down a little bit. The NASDAQ is down a little bit. The Dow is down a little bit. We've got Bitcoin over here. It's down to 19.8, so it's below 20. Makes sense. It's going to follow the market because everything the market does, Bitcoin is now going to do. I mean, it's invested in most of the standard tech stocks at this point. I mean, a lot of different firms, a lot of different companies have exposure to Bitcoin or cryptocurrency in general just to get the volatility. Hey, what's going on in Ashton Phoenix? How you doing? Awesome. What do we got here? Resubscribed. All right. Woo! Ashton Phoenix with the resubscribe. That's how it's done right there. Remember, everybody, resubscribe. That's how it's done. You want to win in the stock market? You resubscribe or you subscribe. I'm just kidding. But now we're talking about the, let's see, we're talking about cryptocurrency right now. So it's following the market mostly. We've got Ethereum and Bitcoin, both of them down. They're off their highs quite a bit. They had a little bit of a pump when everything else was pumping in the market, but we had a bit of a crash too because, well, J Powell scared everybody. He told everybody what they were afraid of, but it's what was expected. Okay, so here's the interesting thing about the market. You will know what's going to happen, think something else is going to happen, hope something else is going to happen, and then the thing you originally knew was going to happen actually happens, and nobody's prepared for it. That's what happens with these big moves. You always think you're going to be ready for the next big move, but you don't realize that you're in bull market mode by the time the move comes down, right? You've extended yourself heavily because you're getting returns from just upward movement in the market. When things start to go down, you don't have any cash or you have very little cash because it's all invested. You have to try to pull it out, but then you think, oh, if I pull it out now, I'm going to lose money and then it'll go up without me and I'll miss out on that. That's what everybody thinks with pretty much everything. But that has to happen throughout the market because it got a little ahead of itself. There was a short squeeze that people took advantage of, and everybody else that doesn't know any better thinks that the market's rallying right now as a permanent thing. Like it's done. Or they're sure that it's going down. They're super bearish. There are so many bearish people. That's actually another thing I want to talk about today. There are quite a few high-profile fund managers that are making serious downward bets. I mean, Michael Burry, he sold all of his stocks, basically, except for a private prison group, from what I can understand. And, of course, this is a snapshot in time at the last filing of his firm. So right now he could be heavily invested in pretty much everything, for all I know. But last time we saw that, he was saying, you know, there's some serious downward movement in the market, and I'm going to put my money where my mouth is and take out pretty much all of his holdings except for, well, except for a prison and mental health care place. I mean, it's probably just a mental health facility. I really don't know. I haven't done a lot of research on Geo Group because that's the stock that he's holding, Geo Group. But he thinks that the market's going to tank, which a lot of people do. And I kind of agree with him. It's hard to say for sure which way I think the market's going to go because I think it's still really up in the air at this point. There are so many factors that could move it in either direction that it's almost like in limbo. There's so much movement that there's no movement. It's weird. It's interesting. I haven't really experienced that kind of a bull market before. I'm an intermediate trader, right? I'm not an expert, and I've only been doing this for about 5 years. So there's quite a bit of history that I missed, and my experience is limited for that point. But in that time, I haven't really encountered a long-lasting or bear market because everything's been in full bull mode since that's what the Fed's been doing. I mean, ever since 2008, rates have been super low. They've rolled out quantitative easing multiple times, and that's moving the market. I mean, that's a way to support things. If you have problems, if you have debt, whatever it is, you sell it to the Fed. I mean, that gives you a temporary Band-Aid, I guess, until you can fix everything else. Because that's what the Fed does. The Fed really can't change anything on the supply side of the economy, but it can work with demand. And really, if you think about it, it actually can affect supply because it's kind of indirectly doing it through how much capital is available for the people that would normally fund those projects. That's the other thing you have to think about. Like, any new endeavor has to have a serious amount of money behind it in order to get it going. So, because you're going to have to pay so many different institutions and businesses and get everybody going, get the employees paid, get it all set up. There's so much cost. So, oh, look at this. We're having a little bit of downward movement. So I thought maybe we would bounce, but it doesn't look like we're doing that quite yet. So I just wanted to watch the futures a little bit because things are extremely volatile right now. And this can give you an idea of where it might be going in the future. So I like to look at it and see what it does, but you can't really take too much of the movement seriously because there isn't a lot of volume. It's only futures traders, like people that really know what they're doing, or, some idiots, because there's always at least some that are just jumping right in. And I talk to people and they're like, oh yeah, I started in futures, I started in Forex, I started in this, that. I'm like, oh wow, that's insane, man. Like, start in stocks. You got to learn the basics first before you go to everything else. I mean, especially if you're doing derivatives. Like, derivatives, you can get derivatives of pretty much anything. So if you're in the bond market, there are bond market derivatives. You don't have to do stock market derivatives. But stock market derivatives are huge. There are so many of them. And now that meme stocks are a thing, there's going to be so much more demand for people to just spend money on this stuff. We've got a platform that allows that. Everybody can come in and trade. There's no fees anymore. It's a different environment. Not to mention, there's so much money being pumped into the system because we're still seeing the effects from the stuff we did in 2008. See, that's the other part of this equation. Like, it's not just the stuff that's going on right now. It's the compounding stuff that we did in the past. If you think about it, there's stuff from like 1940. If you go back, there's always at least something, depending upon how big the change was. But recently, we've had a lot of changes that are actually due to the momentum we've had since basically 2008. Or maybe, I might even say the 90s, because we had the dot-com boom, and that's really what started it. But to me, the 90s and the 2000s, that's a flat era, right? There's this huge bull market that goes up, tops out right around 2000, and then it crashes for a couple of years, comes back up to pretty much the same spot, and then we have the housing market bubble pop. And that brings everything down in 2008. Right? So the Fed goes, all right, let's pull down interest rates, make money really cheap to borrow. We'll increase quantitative easing so that way we can be like, all right, if you have bad debt or bad whatever, we'll buy it from you in some indirect way to just kind of keep these companies going. I mean, there's the whole thing about zombie companies that should have gone bankrupt, but because of the way the system works, are able to stay afloat long enough to just be there. They're not providing any value, or maybe they are, but it's not a lot of value, and they just have a ton of debt, and it's basically the financial system's way of giving them more time to fix everything. I mean, that's kind of what you're doing with money. You're betting on whether or not you can fix things in a certain amount of time. Like any loan you get, you buy a house, that's a bet. You're gambling on the fact that you'll be able to pay that loan back. Everybody thinks like, yeah, I got my job, I'm secure, blah, blah, blah. It's like, no, you never know what's going to happen in the future. Look at what happened in 2020 when everybody lost their jobs all of a sudden and unemployment spiked to like 20, 30%, whatever it was. It was insane. And that happened in like a matter of weeks. And that could happen at any time. So you're gambling that for the next 20 years, 30 years, 10 years, whatever it is, whatever the life of the loan is, you're gambling that you're going to be able to pay that back in time and say like, oh, no matter what, that money will be there. And the good thing is the odds are somewhat in your favor because as inflation grows, it's going to make your debt easier and easier to pay off. Hence the reason that the United States government wants 2% inflation. 2% allows them to grow just enough to keep paying off the old debts and have enough money to continue the new stuff. Which brings me to some serious issues we're going to have in the world economy. All right, so I've had a couple of people ask me about this whole China thing because there are so many issues going on at once over there that people are saying, oh, the Chinese economy is going to collapse, which that's the problems they have. They're kind of on the verge of that. Are they going to collapse? I seriously doubt it. Anytime that there's a huge crisis like this, any government that's in the modern monetary system, even if China is a little different, it's still similar to the Western monetary system because of the influences from it. But like, they'll be able to solve the problem by bailing out the companies. Simple as that. It's the same thing the United States did in 2008. When, oh no, the banks are going to collapse. A couple of them they actually let collapse, which they needed to, so that's good. I'm glad that we didn't keep a higher percentage of zombie companies that are just draining money and not providing any value. Like, see, that's the thing. Financial companies that aren't providing any value are just basically taking up capital that could be going to something better. So that's the problem with the way we run the monetary system is we're basically saying, all right, we're going to keep everybody afloat because we've invented a way to do that monetarily, but it's going to suck a little bit, and it's going to have a bunch of these leeches that just catch on and don't ever go away. They just kind of sit there sucking up money and racking up more debt and not getting out of it. So over time, things are going to change. And let's go back to the futures here. Things are looking pretty flat down here. Like, we had a nice little gap down, not really far. I mean, if you think about the fact that it went from 4,045 to 4,026, that's not that much of a drop. You can back up a little bit and you can see that's, not crazy. The drop we had on Friday was way bigger than that. But that's why we're having that gap down, because seeing this on a Friday is terrifying to certain investors. Like if you're, number one, if you're a new investor, or number two, if you're a heavily long investor, this is scaring you so much. So people are readjusting right now thinking like, okay, we had the little rally in the SPY and it's going to come back down. In fact, let me switch over and we'll get out of this and go to the actual charts. Made it a little easier to see here. So we've got the long-term chart down here for the SPY, and then this is the 3-minute, I believe. Yeah, 3-minute chart right here. This will open later. Stocks open a little bit after the futures. I'm on Pacific time, and they open up about, let's see, 1 a.m., I think, Pacific time. So it should be somewhere around 4 a.m. Eastern. You'll start seeing movement in these. Again, that's going to be low volume. You'll see big movements because there aren't a lot of players on the field, but it doesn't necessarily mean anything because the volume is very low. Like here's an example right here, right? So this is Friday's range of trading. This is the entire day, and this would have been after hours because this is a 24/7 product, even though it seems to kind of close when the futures do and everything. So, but overnight it didn't move that much. You'll see there's very little volume. Like this is the day on Friday. There are millions of shares traded. They would say probably about maybe 500,000 shares at any given moment. And then the after hours has nothing. Pre-market after hours doesn't really have much volume. There's a spike at the end of the day. That happens a lot because people reposition before the close because of the whole low volume thing and because of the uncertainty of what news may come out that could tank or pop your stock. So there's just not a lot of volume. And if you see huge movements, it can tell you that people are nervous. So it's, take note of that, but you don't have to worry about that being the norm because once the day opens, the people that really know what's going on and have the volume are going to put it where it should be. Yeah. So it opened, had a little bit of a pop, and then J Powell started talking around 6, 7 o'clock. Or maybe they started dumping a little bit before that, but I think J Powell started around 7 o'clock. In fact, you can see this volume spike right here is telling me that that's probably where he started. Not to mention there's this huge green, red candle right here. And these are 3 minutes, so this is a huge reaction right here. It's like 5, 6 minutes in either direction. This was a huge panic day, which I'm happy about because we've had this nice run. If we look down here, this is the full chart. We had this little bounce, and right down here in the middle of July was where the Fed said, hey, everything's okay. Our plan's on schedule. Here we go. We're going to actually do this. Boom, shorts got squeezed. Bulls came in, but it's not a permanent rally because there's still interest rate increases. Like we're operating in a different environment. Most people, the people that have been trading for a year, 2 years, 3 years, they've only seen this upward movement because they've seen such low interest rates. I mean, interest rates were dropped 2008, 2009, somewhere around there, and held there for a long time. And eventually, I want to say somewhere around like 2014 or so, maybe a little earlier or later, we started raising rates again very slowly, like 0.25%, 10%, whatever their moves were, very small moves, just kind of inching it up and not trying to put too much pressure on the market because you can't leave it low forever. You have to start paying that back. So what do we got down here? Vlad, how's it going? Just started doing options. As of right now, is this smart? What do we have that's smart? Oh, starting with options. It depends upon what your experience is with the market in general and what your knowledge is of options. Options can actually be really great. It depends upon your account size and what you're doing with them, but they can also be extremely dangerous. So I highly recommend people that are start with stocks just because it's a little easier and you'll get the basics of what happens. And when you're trading options, those options are going to be based on stocks, so you're going to want to know how they move anyway. So it's really good to start with stocks regardless of what you're going to do because things are probably going to be derived from that. Now, saying that, options are extremely risky. I mean, they can move so quickly if you don't know what you're doing, and you'll hear these stories of people putting in a couple thousand and it turning into like hundreds of thousands. That does happen, but those situations are extremely rare, and you have to be in extremely terrible option plays, like really, really unlikely plays to catch that. And if you keep going and looking for those, just like, I got to get that one, you're going to run your money out so quickly. So you have to find a strategy that works with whatever amount of money you're using. So let's see, you're only starting with $100. Okay, so if you're starting with options and you're starting with $100, honestly, options are probably the thing you'll be able to do because if you're buying shares of companies, you're going to be able to get, 1, 2, 3 shares with something like that. And let's say that the company goes up $1 or $2, then you're making what, $1, $5, something like that. That's cool, but that's not a lot. So you can either say, all right, I'm going to do this slow because I just want to make it a side hustle, which if you're using a small amount of money, it has to be a side hustle only. Don't try to make it your own income. Don't think you're going to be a millionaire. Like, just start with a little side hustle and practice because you're going to have to get better. And you're going to miss opportunities that you'll later know are good opportunities. I mean, and the only way you find those is you miss them and you lose. So keeping it a small amount of money until you're winning consistently, because you're never going to be 100%. You're always going to have losing trades. But once you find a way to have your winners outweigh your losers consistently and manage your risk properly, then you'd be able to succeed. So it's probably best to start looking at stocks, see what you can find, learn the stocks that you want to trade options on, or if you want to trade options on other products, learn those products and see how they move. Because what you'll find is that there's a few ways to trade options. There's so many different strategies. It gets really complicated. But if you want to simplify it, to me, it's like this. It's like, are you betting on the stock going up? Are you betting on the stock going down? Or are you betting on it staying where it is? The other side of the coin is, do you want to substitute options for long stock? Because if you want to make a lot of money in some stock, you have to gather quite a few shares over time before it has that huge pop. That's how people made a bunch of money off of Coca-Cola and stuff like that. Over time, they were, working for the company, and it was just adding to their portfolio. And now it's huge. But when you have a small amount of money, it's not going to give you the results you want, depending upon what you're looking for. And the less you're looking for, the better. So it's best to start with something small, know that you're going to lose, and figure out, how do I want to play these options? Up, down, or sideways. That's it. Those are basically your three options. So no matter how complicated any setup is, that's what you're working with. So if you watch a stock, if you watch any financial instrument, you find that it has some kind of a pattern. You go, all right, when it hits this level, it goes down a lot. So I have ways of playing the downward movement. Now, what are those ways? There's one, you can buy a long contract. You say, all right, I think it's going to go down, so I'm going to buy a put. The problem with that is the odds favor the option seller, not the buyer. And if you're buying long options, you're going to be losing more trades than you're going to be winning. And it's really difficult to deal with that when you're first getting in and you don't know how to lose. So that's lesson number one, I think, in my book is, well, lesson number two, really, because first, learn the stocks, learn what's going on, start getting immersed in the lingo. You're not going to understand all of it, but as you watch the content, TV, YouTube, social media, whatever, you'll eventually start to figure things out, and you'll get used to what the lingo is and what people are saying. And then you learn how to lose, right? Because that's the most important part of trading, is the fact that you're going to lose and there's nothing you can do about it. You have to learn how to accept that and how to make plays that keep you in the game if you do lose. Because the point isn't to win any individual match. The point is to gather a number of occurrences so that you can actually make progress. Like, eventually, if you trade enough stocks, trade enough options, you kind of get a feel for how things move, and you'll get a gut feeling for like, I don't want to touch that, or that seems pretty decent right now. It's not expensive, and I think it can move. And those are the ones you're looking for. But let me tell you, those are rare and hard to find, and you have to study this stuff for a long time before you get comfortable. So yeah, the best thing to do is start with a little amount of money, practice what you want to do. I mean, I'm not a financial advisor, and I can't really give financial advice. So this is really just all my opinion. I want to make that clear right now. Like, I'm not telling anybody to do anything. When I say this stuff, I'm talking about myself, and if I was a generalized person, what I would be doing. So everybody has to develop their own method, because when you take everything from somebody else, you're not getting their perspective as well. You're just getting the pieces that they give you, and sometimes that can lead you in the wrong direction. So it's best to have a variety of sources that tell you what's going on. Take from it what you will and do your own research. You don't have to learn everything. That's the other thing too. Like, don't overwhelm yourself with all the stuff that's going to come in. Like, I got to learn this, I got to learn that. Start simple. Like, find a few things you're interested in. Like, the way I say it is, if you have an industry that let's say you work in, a steel mill or something like that, you have some inside knowledge of that, that's a good place to start with your investing. Like, look into those kind of stocks, look into refineries, look into, United Steel and all that kind of stuff. Whatever it is, like, find something you're interested in and just know it. Don't worry about like, oh, that went up and I missed it. That went up, I missed it. No, stuff goes up all the time. You're going to miss a bunch of stuff. You just have to get in the mindset that you're going to find something you like and follow it until it pops or drops or whatever it is that you're looking for it to do. So yeah, I'm currently studying support and resistance, supply and demand trends, candlestick pattern. Okay, well, I'm actually working on a 3-part trading series that starts from like the very beginning. So it's going to go for people that don't know anything all the way up to people that have been trading for a while. And it's just going to be all the basics that have come basically by philosophy, a way to organize how things are done, because it's really hard to figure out what you're doing when there's so much going on. And I'm a very disorganized person, so it's like I have to centralize on something. But the best thing you can do is keep it simple and learn a specific thing. So I've made that point clear, I guess. Let's just say you take 1 or 2 industries, you learn them, you follow the stocks. Then you say, all right, I want to trade derivatives. What I started doing was just buying random stuff and seeing what happens, which is not the way to go. Because if you're guessing on that, those options move quickly. In fact, let me go over to the trade grid real quick so we can get a better idea of how this works. All right, so we've got Apple contracts. When you're looking at options, you're going to see this is the option chain. This is where everything is listed. It's by date. The soonest one, these are usually called weeklies because the big contracts come about once a month and the really big ones come once a quarter. So you'll see, monthlies and quarterlies here in white. It's telling you how many days until they expire. The thing about options is it's a timed process. It's basically decaying every day you own it. Let's go to September right here just to be easy. These are kind of just barely showing right here, but all the Greeks tell you how the option is going to move. And this is something you have to learn if you're going to trade options. It's really basic stuff, but it doesn't make sense when you're first learning it. It takes so long for the concept to actually click. I think I was learning about options for like a year straight before I even understood the basic concepts of how the Greeks work, because it's just not explained very well. And that's actually another video I want to make. I want to make a video on the Greeks because every video I see gets some things right, and then it just kind of trails off, and they always mess something up, and they're just things that none of them talk about. So the way you look at the Greeks is, this is how my contract is going to move. What do I think the stock is going to do, and in what time? You don't have forever to hold these contracts. Now, you can do something like leaps, which is long-term expiration anticipation securities, which basically means that it's a year, 2 years out, something like that, and you're buying into a really expensive contract, but it's not going to decay as fast, because the problem with contracts is theta, right? So you see this column right here is theta. Really long dated contracts are not going to have a lot of theta. I mean, $3, $2, whatever it is, $1, it's not losing very much. The movement of the market is going to cover that up completely. So you have time on these contracts before they expire. But if you buy one of these ones, let's say you want to gamble, you're a degenerate and you want to buy weeklies. I always say never buy weeklies. Just never buy weeklies. That way, when you do buy weeklies, it's not that big of a deal. If you just buy weeklies all the time, you'll lose so much money you won't be able to make it back in other strategies. That's just how options go. And that's what people get into. They're like, I just want to make something real quick. I'm just going to get these weeklies because this $7 contract could go to 1,000 if the stock moves enough, which it could. There's always the chance that some stock just randomly pops, and these contracts become insanely expensive. I mean, they're starting out as literally $7 or $5 right here. This is the bid-ask spread. So this is telling you what the sellers are willing to sell it for and what the buyers are willing to buy it for. So the top buyer is offering $5 for this contract right here, the 177.5 contract in Apple, meaning they think by next Friday, the stock will go to 177 from where it is at 162, which is very unlikely. It actually could do that if the market rallies. I see that as a total possibility, but it would be terrible to spend a bunch of money buying these contracts because most likely they're going to expire worthless. And why is that? Because of theta, right? And you look at theta right here. Remember, it was like 1, 2, 3 at the most. Look at it on this one, 37, 32, 24. That's telling you $37 a day is getting eaten up by theta if it's just sitting there. That's not even if it's moving in any direction. That's just if it's sitting there. So theta is your time decay, and the closer you are to the expiration of the contract, the more it decays, which is why leaps are nice, because you're not losing $37 a day. But if I go look at this, June of 2024, so that's quite a ways off. It's way more than a year. If you go to that same contract, where is it, 175? It's as close as we're going to get because the strike prices are in $5 increments. You see, these are called strike prices, 65, 70, 75. What did you say? So did you pay for a class to start learning all of this? No, I didn't. You can actually get all of the information you need for free on the internet. That's what I really like about YouTube and social media is there's a ton of bad information. They're toxic places. I know all that stuff. But sometimes you get good information and you can actually learn how to do those things based on that. And that's what I like about trading leaps. It's not a degenerate gamble. You have time. It's similar to actually owning shares. But let's say you wanted to own 100 shares of Apple, right? That's 100 times $162 a share. You have to fork out a lot of money in order to own those shares, but you could own the same amount of shares for a cheaper price. These are supposed to be per contract, so you multiply this by 100. So $3,400 to own the 165 strike. Right? So you can own 100 shares of Apple for $3,400 versus having to pay the entire amount on the shares. So that's the attractive thing about these, because this gives you the right to actually buy those shares at a specific price. So if you buy this call right here for 3,400 and Apple actually goes up, this thing goes up in value. I mean, you can make a few $1,000s if this is going to 177 or 180 or whatever it is. So it's nice to have that protection from theta, and you can still get exposure to the movement. But the downside is you also get hit with the downside. If it goes against you, you're losing delta, right? So that's the first number right here. Delta is how much you make or lose per dollar that the underlying stock moves. All right, I hope that makes sense. It's basically saying for every dollar that Apple moves, this option contract will adjust its price by about $63. That's why this is so powerful. For every dollar that the shares move, you make $61. So you can basically supercharge what you're doing by buying quite a few options. Let's see. Can we chart some shit? Yeah, we can chart. What do you want? Put something up. Let's talk about it. So I'll just wrap this option thing up real quick, and we'll get to some charts, because I actually have a few stocks that I wanted to talk about. So my recommendation is just practice for a little bit. Study on YouTube. You don't have to buy a class. You're going to see these classes that are really expensive, and these gurus, oh, I'm so good at trading and blah, blah, blah. Don't worry about it. You don't have to pay that money. Like, I didn't do that. I'm not perfect. I'm an intermediate trader. I still have a ways to go, but I've gotten to a point where I can actually consistently make money, which is something that it took quite a while to actually happen. So let's wrap this up. Just practice for a little bit, and then eventually you can start adding more when you get to things. So what do you want to talk about? Do you have something specific you want to chart? Because otherwise I'm just going to start talking about the stuff that I've been working on. So let's see. You bought a class? No, that's fine. I'm not saying you shouldn't buy a class at all. I would say you don't necessarily have to, but the good thing about buying a class is all the information, if it's a good class, because I don't know, what you bought or what is legitimate anymore. I'm not paying attention to that stuff. But you can get a lot of good information from those classes. So I'm not saying never do it. Like that's the thing I want to make clear. Like, I don't want to knock these things. I think classes are great. I'm trying to figure out a way to get something going myself for just the basics, just all the stuff that was trouble for me. And I want to teach people how to avoid that stuff. I want to get people to a point where, like, finance isn't so scary, because I kind of grew up in an environment where finance just wasn't talked about. It was a little bit like, oh, it's gambling, don't think about it. But it's what you make of it. It can be gambling, because a lot of people use it to gamble. When everything closed and the 2020 pandemic started, the gamblers who couldn't go to the casinos were going into the stock market, going into crypto, going into the futures market, etc., just blowing things up with their gambling. But you can actually research the things you're looking at. A roulette wheel, you're spinning a wheel, that's all chance. But with a company, you can look at things like, how much money do they have? How much debt do they have? What event just happened that allows them to move? Like, are they being priced incorrectly? Because that does happen. Algos are running around at light speed trading things, and they make mistakes all the time. They cause huge moves that shouldn't happen, and that's when you can get in. So these people are like, oh, the algos you can't beat the algos. Yeah, you can. The algos are stupid. Like, they're super smart in the way that they're trading, but the result of all of them battling together actually creates a great opportunity to make money. And that's why we have these huge drops, because these algos are messing stuff up like crazy. So let's see. All the info's there, but imprinting in my brain is something else. Yes, that's the other thing. It's going to take a long time to actually get the stuff. The first few months I got into trading, I learned so much. Like, I would say 80 or 90% of the stuff that I know, I learned in those first few months, like 6 months, let's say. And I thought I was an expert at that time, but to actually have the stuff make sense, the deeper concepts, the stuff that I hadn't really even gotten into yet, it just takes time. Like, and you have to actually experience the wins and the losses, because you have to know how to react. Like, when you win, you're going to be tempted to do more. And that's the thing you definitely have to avoid. So when you win something, you stop and you figure out, all right, what was I planning on doing with my money? Like, what I do is take the winnings that I have, leave some of it in the account to grow the account, and take some of it to buy some long stock that I'm investing in for the future. That's something that I'm not going to be paying taxes on right now. I'll be paying taxes on it later. It's also an investment. So it's a way to move your cash into something that you think it's going to grow, instead of just gambling on more options or gambling on more stocks or whatever it is with it. Like, take a chunk of it and put it somewhere where you don't touch it. And I think the best thing is to even have a passively managed index fund, like somebody else. Have a company that knows what they're doing, or a financial advisor that knows what they're doing, managing their money. You can take some of your wins and put it in the account that they run. And that's a good way to hedge against yourself and to get all the stuff you don't know. Because they have degrees and all the stuff. They know things that we're never even going to start to scratch the surface of in our life. So it's good to have them doing something for us and actually figuring out the stuff that we don't know. But they can say, hey, this is our plan, and simplify it for us. And we can be smart enough investors to figure out what they mean. Like, I think no matter what, you should know at least enough about money to understand what the people managing it are doing. Because a lot of people just throw their money in and go, oh, that's it. I don't care. Like, no, you need to learn the market and say, what are you guys doing with my money? Like, what are your investments? Because some of these firms are terrible. Some of these people are investing in such stupid stuff, or they're trading high risk bets, and you just want to make sure you find something that works for you if you're going to do that passively managed thing. But there are actually a lot of funds out there that are good, and it's not that hard to find them. And a lot of people just get something like that through their work, any kind of retirement fund, whatever it is. So what I do is, like, I take a little bit of my winnings, I put it in the long account, and I grow my 2 trading accounts. And then whatever's left over, I think, all right, I'm going to have to pay some taxes on this. So save like a little bit of it for taxes, and then continue to go. But I don't make trades all the time. So it's not like every day I'm popping money in there. It's like, no, I make 2 to 5 good solid trades in a quarter. I'll make a lot of little other stupid trades with tiny amounts of money. That's just, sometimes it's for entertainment, and sometimes it's because it's like, it's a good odds trade, but it's not something I normally do, so I'm not going to put a lot of money into it. So those are the things that if I'm going to lose something, I usually lose those. But then there are the big ones that I track and follow for months until the date actually happens, and I can take a nice profit. Because if you're trading for, like, I got to get in there in 5 minutes and make it, you're going to get crushed. That's a terrible environment. You have to have a certain personality type to be able to do that. And I don't have it. Some people can, but a lot of people can't. So it's better to think like, all right, what are my strengths? I'm just going to stick to that and try to actually focus on those things so that I can make progress on something rather than generalization of everything and no progress on it. Because you'll just start looking at stocks and be like, oh, I missed that one. That one went up. I missed GameStop. I missed this. Well, yeah, you know what? I own GameStop. I owned 50 shares of GameStop like a month before it went to 500. And I made $1 a share on it because I was just messing around, basically. I was like, all right, I'm just going to buy a little bit here. I'll get some more later, because I usually start with a small position and then get my full one later. Well, I missed out on it. I forgot to buy more. So I was like, all right, I guess I just have those 50 shares, whatever. And it went up $1 or $2, and I sold it and went, ha, there you go. I was all happy about that. I made my $50 or $100 or whatever it was off that stupid trade. And then a month later, it's at $500. I bought it for $16. Can you imagine 50 shares of that going to $500 on a stupid random trade? Or if I had remembered to put my full position size and had like hundreds of shares of it or thousands of shares of it, then it would have, like, game over. I could be retired if I had that. Do you have any idea how shitty I feel about that? It's terrible. I did the same thing with crypto. I started buying in like right at the end of the down trip, and then right at the lowest point, it was close to when I was starting. So I just dumped everything. I was like, all right, I'm done. I can't do this anymore. I've lost half my money in this already. And that's when it started to go the other direction. So I was chasing it and going, no, I don't want to buy in at the top. It's too hard. It wasn't the top. It just kept going. So I didn't have a huge position as much as I had before I sold it. So, like, there have been so many mistakes that, oh man, that they scar you. Like, they really, really scar you. But the good thing about them is you learn. And if you continue to trade, if you can get past it and get back in the game, you're better than like 85 to 95% of people that trade. I think it's like 80 to 90% of people lose money in the market when they're trading. It's a huge majority, and a lot of those people quit. So if you can continue after your losses and just don't bet so much that you're out of the game, like, never jump. Be like, all right, always say, all right, I'm gonna need more for another day, no matter what. Yeah, it's a grind, but if I continue that over time, I can take bigger and bigger bites out of things, and eventually it won't be such a big deal. So what do we got here? So do I do this full time or just a side hustle? I do this as a side hustle. I have multiple streams of income, but this, to me, I started it because I wanted it to be my main income source. I spent a couple of years trying to make it my main income source. I wanted to be a day trader. I was trading penny stocks. I was trading crypto. I was trying to get that all down, but that really wasn't my game. Penny stocks are difficult because you can't get very accurate information on a lot of them. If you're trading blue chip companies, so much is available and they're all over the news. It's harder for them to make sneaky moves that you don't know about. But in a penny stock that's just some random company, it's a shell company and they're really just trying to pump a stock and sell it, then you don't have any way of finding that. I mean, some people have inside information on, oh, this is a scam, don't get involved in it. But a lot of people don't. You just see the news. You just see what's going on. So you can only make your own decisions. And you can't get caught up in anything because you never know if there's going to be a rug pull at any minute, right? I mean, look at what's going on right now. People are afraid. In the top left-hand corner right here, we have currencies. It's just an idea of what they're doing right now when they open as well. Everything's down, right? And then you have this is Apple, but if we switch back over to the S&P 500, see over here, we've got a little bit of a gap down too. And that's telling you that people are a little bit afraid because what's happened so far. Now we're getting into charts. All right, so finally getting into the charts. So learning about charts here, I think the best thing you can do is just try to go for the basics of technical analysis, right? So if you're just starting off learning charts, learning technical analysis, I highly recommend not just getting into the TA only camp, because that's kind of how people fail. They go like, all right, it's astrology. It's the same thing. It's like looking at the stars and going, oh, you know, that's a snake or whatever. I'm going to make something about it. It's the same thing with these charts. But the difference is they're just looking at charts from the past and saying, look at similar patterns. You can see similar patterns have similar results. So they create a whole technical analysis thing. Like when you see this pattern, then this is the next move and you go for it. Well, it may not be the next move. What they're showing you are the ones where that move actually worked. They're not showing you the majority of the time where it doesn't work. So make sure you're in the fundamental and technical analysis camp, because technical analysis is important. You can't ignore it. There are certain things that do happen over and over again, and there are certain self-fulfilling prophecies that happen over and over again. So it's good to know that stuff. And that's why I'm looking at the charts. And actually, instead of going with the Qs, because we this one's volatile, I want to go with the E-minis. Actually, you know, I'm going to go with the SPY, because the SPY actually has volume. So this is a representation of the S&P 500. I have this set up right here that has a few indicators on it. If you're using technical analysis, you'll see that sometimes people have charts with stuff all over it, right? There'll be lines all over their chart, and they're saying, oh, there's this, that, and it's this bull flag, and it's a shooting star hammer doji thing. Like, that gets a little intense. Like, you can't use technical analysis on every little bit of information you see. Like, every little level is a thing. So what is it? You said something about a series and all that in your Discord, TD Ameritrade, I think. Yeah, I'm using TD Ameritrade. This is Thinkorswim. But I'm talking about making a basic intro video to trading, like how to invest, how to trade, in my opinion. Like, this is what I'm doing. And the first part is kind of just getting going. I'm going to have that going soon, but it's a 3-part series, and I'm trying to get more and more advanced with each one to cover a lot of these concepts. Because what I'm finding is a lot of this stuff, you can't, so it's okay, buy a class, right? Do you want to buy a class or not? It's good to buy a class because everything's organized for you, or at least most stuff is organized for you. But when you're doing it on your own, it's going to be messy. Trying to find all the information you need to find is difficult sometimes, because sometimes people will say one thing and then this other channel says another thing, and you don't know who's right. And this, you research it on your own and it says a different thing, and you have to mesh everything together until you find it's just such a process. But you can do it. So if you're really dedicated to it and you really want to make something of it, you can definitely do it. But just know that it's going to take a little time, and be willing to put that time in. Because yeah, it sucks. But once you get it done and once you've actually put in the work, it's nice to have that knowledge, because you can use it later. If you don't end up being a trader or whatever, knowing what's up with investments will help you when you're getting a job and they're setting up a retirement account. They're like, all right, we have these different packages. Which one do you want to pick? If you know something about investing, you might go, oh, look at this. This is way nicer than these. I can actually make more money getting this package than just trying to get the pay by itself or something like that. You know, so it's good to have that knowledge regardless of what you actually do. That's why I think there should be more financial learning in schools. Like high school should have some kind of a finance class just to get you the basics, because you always hear like, they never teach me taxes, they never teach me this, which is right. I don't remember learning any of that. I mean, the economics class put on a movie. It was like, in economics, they're like, all right, we're going to teach you about stocks. Here's the movie Boiler Room, which is mostly just about like cold calling customers and trying to sell terrible stocks and stuff. It's like, all right, there you go. There's your knowledge of the stock market. I mean, what is that supposed to do? Right? Like, you need a full, well-rounded view of what's going on. And there's so much stuff they're trying to teach you in school. I get it, but it's extremely important, because if people knew more about the market, more people would invest. People would invest smarter. We wouldn't have so many idiots driving the volatility like all over the place like it is. I mean, volatility is nice because you can make all kinds of money off of it, but it's also difficult if you're trying to go long. All right, so these are the indicators I was talking about, going back to the reason I actually switched over here. You're going to get all kinds of different views. You're like, all right, check out the MACD, check out the RSI. You know, we got all these different oscillators and stochastic things. That's all good to know. I got into that a little bit, you know, and some of it's really interesting because there are certain patterns that are really advanced and actually do play out a lot, but it's difficult to trade them if you haven't been trading for a while, because you need to know how things move, how things work, and it's not that easy. If you don't know what you're doing, just passively long-term investing, dollar cost averaging is the absolute best strategy. And I could tell you, as somebody that's been trying to trade as their main income source for years, it's difficult. It's not easy. It sucks. You can do it. You can actually get past a lot of these things, but it's really difficult, and you're going to have setbacks. You're going to think you get things and just have massive setbacks, and it's, oh God, it's awful sometimes. But if you can get it down, it's a wonderful thing, because now that I have switched it to a passive, or not passive, but I've switched it to a side hustle, and I'm okay with that, things actually work a lot better, because I'm not sitting there trying to find a trade like I feel pressured, I have to make money right now, I'm not making money, and I feel a lot of stress, and it sucks. it's easier to just be like, all right, I'm going to put this on the side. I'll wait for opportunities that I know. And when they come up, I'll make a little money. And that's it. I'm not sitting here trying to find profit every day. I'm not trying to have Lambos and all that stuff right now. I'm just trying to continue. Like, I want to be able to play the game so that I continue. There's that, game theory or whatever, where they're basically saying that, like, it's over the number of games. You're not trying to win any individual game. You're just trying to sustain yourself. And that's what I think the best strategy is in trading, because if you continue to go, your losses will drop. And what happens with people is they get desperate and they start trying to overcompensate by adding more and more money to these gambles that they're doing. They're getting, in was it poker? There's tilt or something where people get a little emotional and they start trying to win back their money as opposed to actually playing the game. The exact same thing happens in the stock market. And it's so nice for everyone else because it causes the volatility that you can make money off of. But a lot of people don't know how to manage that and they blow up. They use all their money. So what do we got down here? I know that in the market there's a lot of volatility, but what should my range be when trying to predict the trend? Okay, so that's a good question. The way I look at the market is there's three directions it can go. If you're looking at a stock, is it going to go sideways? Is it going to go up? Or is it going to go down? What's going to happen? It has to be one of those three things. And it can be kind of a combination of the two. Sometimes it's like sort of sideways and down or sort of sideways and up. But to me, I'm saying definitively. Is it definitively going up? Is it definitively going down? Or is it definitively going sideways? Because you can make money off of all of them. The question is, how do you do it? So if you're going with long options, that's going to be difficult. And a lot of people will say, all right, if I'm going to buy options, what am I looking for? I'm looking for the range that this thing is actually going to move. So you're talking about what should I look for in a range? Since this is the beginning of the year right here, I have the year marking lines turned off, but you can tell that the highest day was basically right before the end of the year, or right after, or something like that. And then we've been in this downtrend ever since. But if I back up to where I was before, you can see I have these lines going across. These are standard deviation channels. And these have been so helpful for me. Now, they're not something that's definitely going to happen, and I usually put my charts on long-term time frames. Like right now, this is a weekly chart, so every one of these candles represents a week. I like looking at things over the long term because those trends are a little easier to ride than the ones that you're getting daily. Those really short-term ones that maybe they're really powerful, maybe you make a lot of money, they're just hard to get on. And I mean, some people can do it. Some people are good at it. I'm just not one of those. There was this one guy I was watching that was talking about he trades scared. Like, I like that, but at the same time, not really, because that causes you to take things out and to be like, I need gains, I need gains, I need gains. That's not the way to think about it. You can't be always chasing those gains. You have to have like multiple strategies running so that if one of them is working out, it covers up for the one that isn't. And you're not going to go bankrupt if one of them doesn't work, right? You want to diversify, like they talk about diversifying stocks. I like diversifying everything. That's why I have multiple brokers and I have multiple strategies. I have dollar cost averaging long strategy, which is, with pretty much every study they do, the best way to go, the way to make the most money. And I realize if I had just done that from the time that I started up until now, I would have way more money than I do right now. But I'm talking like ridiculously high amounts of money compared to what I have right now. It's frustrating to know that, but at the same time, I also go, okay, I understand that. And the only way you get those kind of gains is if we have a pullback good enough to get another bull market like we saw last year or the last 2 years. And really, the last 10, it's just been bull market until there are little hiccups ever since 2008. I thought last night it's like the, all gas, no brakes thing, right? The Fed basically pushed on the gas after 2008, and we kind of drove until we hit something in 2018 and then really crashed in 2020. So we pushed on the gas more. We just got out of there. That's what we did. It's a hit and run. And that's what the market's feeling is and has been for the longest time. So I'm going to take advantage of that and say, all right, I'll take advantage of the long side for some of my capital. And then the other part, I'm going to leave in cash because you always want to have money for your life, right? If something goes wrong, you got to be able to have enough cash to fix your car or your place you live or whatever it is, medical emergencies, anything. So you got to have something. You can't just be taking all your money and trying to, gamble it away or whatever. But it's also good to put that money somewhere where it can grow, in my opinion. I mean, everybody's different. Like, I go to a financial advisor and figure out what to do with your money. I honestly think that's the best way to go. Instead of just like listening to some random guy on Twitch or YouTube. But the way I see it, it's good to have a little bit of everything so you can have that long position. Maybe if you have a financial advisor, they run it for you. So you hedge yourself. You're not just hedging the market, you're hedging your own decisions. It'll be a group of people making decisions with degrees, and regardless of what their intentions are, if you find a decent one, it should be okay as far as just getting general returns with the market. And if you get general returns, it's better than just sitting there with cash and having inflation eat into the value. So I like to take a little bit of cash that I'm going to use for an emergency and put it in something that makes a little interest. And one of my trading accounts actually has a feature that you can gain interest on sitting cash. So I'm doing that and just letting the cash sit and gain interest. So if I need to use it, it's not only there, but there's been a little bit of growth that I can move into something else or keep in the emergency fund and just have more of an emergency fund. And then I have my trading accounts where I'm mixing between trading option strategies and actual stock once in a while. And the option strategies are even varied themselves, so I'm diversifying that. Sometimes I'm selling options because you have a higher probability of success, and sometimes I'm buying them when I think there's going to be a move that supports it and when they're cheap enough. So that's the way I've realized you have to look at options. Are they cheap enough to actually buy if you're going to go long because the odds are against you? Or if you can sell, is the premium high enough and the probability low enough that the thing will move, that it's worth selling options and collecting the premium? That theta that I was talking about earlier, the person that sells it collects that. So what you're doing as a seller is basically taking on the risk of the stock, and you're gaining a premium to do that. So when you sell the options, that theta is going into your pocket, and you can get out of that trade before it's over. You don't have to ride the thing all the way to expiration. You can say like, all right, I put this trade on a week ago and it's like 50%, it's at 50% profit, because you can see what your profit is. Whatever you sell the contracts for, that's your max profit. So if that full thing goes away, you get to keep all of it. But if it goes down to like half and you want to get out of the trade, you have to buy it back. So you're going to buy it at that lower price if it went your way. So let's say you sell a contract for $500. You wait, a couple of weeks and it goes down to like 230. You think, all right, that's a good amount that's more than half. I'm going to go ahead and take my gains and get out. You buy that back for 230 and you keep the difference of the 500 that you received and the 230 that you had to pay back. So that's a good way to go if you think stocks aren't going to go in a certain direction. If you want to bet against somebody that goes up, or bet against the market going up or going down, you can do that. You can also say, I think it's just going to sit there, which is usually where I like to use the option sale tactics. Like when I think something's not going to move and there's a bunch of volatility driving the premium up, meaning the amount of money that you'd make off of it, I like to sell those during those times. And when that volatility goes away, that premium shrinks quickly, because the premium's going up because a bunch of gamblers want to buy those options. So as a seller, you're thinking, all right, how much money can I make versus the risk that I have to put on? So that's why you want to make sure you get a good amount of premium to take the risk, because if things go against you, you're responsible for 100 shares of that stock or whatever the underlying is for each contract. Each contract controls 100 shares. So if you're selling multiple contracts, you could be responsible for hundreds or thousands of shares. So you got to know what you're doing if you're doing something like that. But I make tiny little sales. I mean, I'm talking like I use a $5 wide strike, so my max loss would be 500. But what do we got here? We got something else. I was about to use the Webull to trade, mainly for options. The people that I bought the class from showed me a way that I could get level 2 trading. Should I use an app like Robinhood? It seems easier on that app to buy and sell stocks for now. Actually, Robinhood is what got me into trading. I don't have like any affiliation with any of these places. I kind of use a few of them and they work out. I mean, there are a lot of good ones. There are ones I don't use that I like, but something like Robinhood is really easy for options. That's the thing people kind of say is bad about it. They go, oh, it makes it easier for people to lose money. Yeah, it does. It really does. It actually really does. But it also is a way for people that don't have a lot of money to make money. And that was my situation. Like I started out with like $1,500 and I turned that into quite a bit of money and thought I knew what I was doing and put a lot of it into an investment that would have made me extremely wealthy. And I lost a big chunk of it. So I almost gave up, but then I came back and I've been grinding my way back ever since, just using very small strategies. I'm trying to get little amounts of income here and there until I'm confident enough to put more money into it. So I'm limiting myself to about $5,000 per account because I don't want to go too much over that and start getting into those same risk tolerance areas. Because that's the other thing you have to think. It's like, what is your risk tolerance? How much of that money are you willing to lose is basically what that means. Everything I put into my account, I'm willing to lose. I don't put any more than that in there because if something happens and you don't have that money, you're screwed. So I don't want to play that game. I don't want to try to bet the house and see if, oh yeah, I could be a millionaire if I make this one trade, but it costs all my capital. No, I'm not going to do it. I'd rather be a millionaire in like 20 years than risk that's just blowing up completely and doing it instantly. Because doing it over time, eventually, I mean, it's nice. That's what I've realized is like doing these small little trades and going strategically for the bigger ones. is a way better way than trying to go all out with everything you see, because it's so hard to make back what you lose when you do that. But if you're like a sniper, if you just kind of come in and get these things here and there, oh man, it's so much better. It's a great side hustle that I hope to one day turn into a main thing. But as of right now, it's still my side hustle, and it's going a little bit. And you know what? You could have any account size. You could have $1, you could have $1 million. You're still going to be using similar products, and we're still going to be thinking the same thing. So the information that I've found is stuff that I think works for pretty much any amount of cash. So I try to make these trades safe for myself, because I can only risk so much money. And then I have my long portfolio that I just add to. I don't sell those. I mean, sometimes I'll make a little trade in that portfolio if I need to, but for the most part, I'm just adding to it. Even when I'm getting crushed, like this whole drop right here, it doesn't look that bad if you, if you look at the whole, like if you zoom out, you see like, oh, look, that's not that big of a drop. Look at how far you're up since. Here's the 2008 crash. People are way up since then. I mean, the SPY was $66 at its low. And I mean, look what the SPY is right now. The SPY is $405 after this huge drop. You could have bought it at 60 when you thought the world was ending. But people got out of it and made it super cheap, and now look at where it is. But if you got in after that, this hurts. So my long portfolio has been getting crushed through this entire thing. And it's good because I use that as a chance to buy. So if you want to actually go long, if you want to buy stocks, you kind of have to be a little bit of a masochist, because the time to buy is when everything hurts, when what you've put in is way lower. You go, oh man, I wish I had started here. I wouldn't have lost so much money and I'd have more shares. Well, you're always going to think that, because it's going to be so hard to time the bottom. That's why I say mix your strategies. So as this has been going down, I've been using my option wins from betting on it going down to build up my long portfolio more. So that way, when it continues to go up, everything is going to have a better cost basis, and I'm not chasing the market like I was before. That's what happens with a lot of people. They follow it up, they chase the market, and they don't know how to deal with it. That's what happened to me. The first year or so that I traded, there was a huge crash, and it's one that people don't talk about right now. It was like 2018. Yeah. So towards the end of that year, there was interest rates were starting to get pretty high, and the market freaked out and crashed really quickly. It was super volatile. I didn't know anything about trading at the time, or investing at the time, and it was scary to me. I thought, oh man, is this the end? Is this, when everything's going to finally crash? Because I believe those videos that you see on YouTube all the time, like, oh, it's the end of the world, the dollar's going to collapse, we got to do this. They're just trying to sell you gold, or they're trying to get clicks. That's it. There's yes, I know there's other ways of making it, but I'm just generalizing it into that, because that's what it is. It's a bunch of gold bugs sitting there trying to sell you their gold, telling everyone this time it's worse than 2008. It's always worse than 2008. And it's never worse than 2008. All right? It's never worse. And they always say it is, but it's never worse. One day it is going to be worse. Yes, it absolutely is. And it could be right now for all I know. But if you bet on that all the time, you're going to lose. Look at the thing historically. All right? Let me back up on this. In fact, let me switch this to a different time frame so we can get a better idea of what this actually looks like. This is the SPY buy quarter. It started in 1993, and then we had the dot-com boom. You can see, look at all these green candles. Every single quarter was green. It was amazing. This was the time to buy in. This is a mania right here, right? When you see something when you see the constant green candles, that's a mania, because that doesn't normally happen. And look at what the consequence of those candles is. It's that huge drop, right? We had the dot-com boom. We had the dot-com bust. There was just huge volatility around that time, and things changed a lot in the market. So then finally we had a pump again. The housing market was going up. Everybody thought that wasn't going to be a problem. And then look at what happened. People that were taking on the risk for these loans were lying about how much money they had, so they couldn't pay it back when things actually started to go down. When the loans came due and the defaults happened, the people responsible for those didn't have the money, because the whole problem was people were trading basically insurance. It's like a high-level version of insurance in the derivatives market for these things. You can say, all right, I'm going to take all these loans, I'm going to bundle them up and sell them to somebody. And that person that buys it says, all right, I want to hedge these loans, so I'm going to swap the risk with somebody else. So I can receive regular payments for holding this thing, but I don't have to pay if things get extremely volatile. So then some other company says, all right, we'll do that. We'll take a premium for doing that. And then, it works out for both of us. Well, eventually, if things crack, the people that are responsible for it have to pay it, but they didn't have the money, so all these companies went under. Lehman Brothers and the other one that I'm forgetting right now, they went on TV right before earnings, or right before all this stuff happened. I don't remember what the exact date was, but they basically came on and said, all right, everything's fine, and the very next day they went bankrupt. So what else do we have right here? What would it be buying long-term stocks, or also buying and selling short-term? If you're talking about a diversification of strategies, I kind of do all of that. I want to have my long-term dollar cost average account, because that's the best thing to do. And that's what this chart shows you. And that's actually the reason why I brought this up. people that are negative on the movement of the entire market basically have always been wrong. In fact, if I switch this to the actual S&P, so let me go to SPX so we can see the history going all the way back to like the 20s. So, all right, so here is the S&P 500 going back to basically 100 years ago. So here's 100 years of data on the United States and in some ways the basic Western market. The whole reason I wanted to show you that is betting against this is usually wrong. So if you're one of those people that's constantly betting against it, look at this way. Are you shorting this? This right here, everywhere along the line, oh, it's going to be over. It's worse. It's worse. It's worse. Because this is still in people's mind. Yes, this was a crazy time. I mean, both of these were. And it got a lot of people out of the market. But look at what happened. It kind of established this range, you know, with this little M shape right here. It kind of double topped. And then it double bottomed. Right? It took off, right? The Fed was like, all right, here you go. Here's free money. Also, here's a way we can buy up your crappy debt so that if you're a failing company, you don't have to fail and people can keep their jobs and you can keep going with it and not providing any value. Boom, here you go. We'll let you do that. And that set the market off. And every time something comes around like this, you see these people coming in like, this is going to be worse. This is it. This is the crash. It's never the crash, all right? It may, until it is the crash. Like one day it's going to be the crash. But mostly it's not going to be the crash, so you don't have to go crazy. You can use these dips as a chance to buy. It's not a crash, it's a dip. And yes, this is a huge move. You got to think about it. This is 2 straight quarters of extremely red movement. And we have had a bounce in the third quarter. We've got 1 month left on that. So we'll see what actually ends up happening. But this is a huge move downward after so much up. Look at this. We had the pandemic crash, which was 1 month. If you think about how long that felt like it was, the crash was 1 month. That's it. And then it was all green candles until the beginning of this year. So basically a year and a half or more of straight green quarters. This brought so many people into the market that this is all a lot of people know. So this crash has gotten rid of a lot of the new traders that don't understand what's going on. This is actually a much better time to get into trading than this. Because if you think this is the normal and you start betting like that, this is going to blow you up quickly. You have to know that this happens, so you have to be ready for it. And you just want to keep adding to your good positions so that when it pops next time, rising tide lifts all boats and it can get yours as well if you're smart about it and you have the right investments. So what I look at is like general market trends. What can I get right here? So what do we have? In your opinion, with your wisdom trading, and you had a $100 account right now, what would you start doing? What I would do is, number one, I would say, all right, what do I want to do with my winnings first? If I make money, do I want to make the account bigger so I'm trading with more than $100? Or do I want to take it out and spend it on something fun? Or do I want to add it to like a longer position, a retirement account or something like that to help that grow? I like to put it in the retirement account because it's like you could buy, I don't know, a yo-yo or something. Like, I don't know if anybody's going to buy a yo-yo, but let's just say you buy a yo-yo, right? That you'll have fun with that for a couple of weeks and then it's done. And that 10, 20 bucks you spent on the yo-yo is basically gone. Or you spend it on some food. You go and you buy a burrito at a taco truck that's terrible. So you spent, you and your family $30 getting these terrible burritos that nobody liked. When you could have taken $30 and bought a crypto that went to the moon or something. Because when you make some money, you got to figure out what you want to do with it. And know that using $100 is not going to get you that much. It's going to be small increments. So it's going to take a little while. But if you can add money from external sources into it, over time, you can trade with bigger and bigger amounts. So if you're using your winnings to add to something, I'd figure out what I want to buy and then maybe buy like one little tiny share of it so that I know what's going on. And that way you're getting that in your brain. So part of it is like, how do things move? Not worrying about that $100, but worrying about learning how to catch things as they move. Because you'll find that there are patterns. And when events come up, binary events like earnings and things where there's going to be a reaction, you can start to kind of figure out how to use those. If you own the stock long and it tanks on one of those, you can buy a little bit, use it as a buying opportunity. Or if you think the volatility is just going to go up and nothing's going to happen, you can sell options on that and actually collect that volatility when it comes down, when there's a volatility crush, like after earnings, if nothing moves. I think I missed something down here. It said invest, compound, and make more while gaining knowledge to do all the types of trades, such as stock and options, etc. Yeah, learn it all. Like that's what I said. So what would you do with the thing? I'd learn a stock. Like, let's say Snapchat was the stock you wanted to learn. I'd say, how far out in time can I go with that money to risk that? So technically, you could buy this contract right here with that $100, right? You could spend between 82 and 89. So let's call it 85. Let's say you get this contract for $85. So you have until June of 2023 for Snapchat to go above or at or above $20. And this, every time it goes up $1, your gain will be, what is that, like $30, $20, something like that. And that gets bigger as it gets closer. So you could do something like that. But that's the thing. You only have that one play, right? So if you're only using $100, that $189 option is basically all you're going to be able to do. You could gamble, which is the one I don't like doing, and get the one that's right here. But what I like is this is cheap. Like if you wanted to risk $12, if $12 is an okay risk for you, you're okay just throwing that in the toilet, then this you could buy one of these and still have a good enough chunk of change left over to make other trades. But this is probably not going to work out. But the fact that it's hammered so hard, these options are like unfairly priced, basically. These should be more expensive than they are because a move up to this level is actually likely. But because everybody hates Snapchat and they think TikTok's about to blow everything out of the water, which I think it is, but these social media companies are going to adapt and they're going to do other stuff. There's going to be pops in it. There's going to be news catalysts that make it move like there always are. So I think this stock could switch directions and become a huge bull stock. Like when you go back to look at the chart, when this green was going on, look at how many quarters. This is like 2 straight years almost of upward movements. These option contracts, like the calls for this, were so expensive. People that were trying to get in up here were paying huge premiums in order to continue to ride. So if you got in anywhere up at the top, you lost big, especially if you held. But if you just went from like here to here, you probably didn't make anything because there was so much extra premium involved to buy those contracts that it washed out whatever gains you probably had. So the people down in here made a ton of money if they held, but the contracts were so expensive. Now the same thing is happening in the other direction. See, that's what I like about this stock. Some people are good at finding stocks to short or stocks to do this. I'm good at finding stocks that are beaten up too much, like unfairly beaten up stocks. And Snapchat is one that I like for the future. Now, is it going to happen tomorrow or next week? Probably not. This is a long-term thing. It's probably going to take months or years for this stock to pop. And it might go to zero. I mean, there could be other problems. But at this point, looking at the financials, looking at what the competitive landscape is, I think it's going to be fine for a while. And at the very least, there's going to be pumps, even if the company isn't doing well. Because sometimes the company just puts stuff out to pump and dump their own stock. It's not legal, but they do it in ways that aren't traceable, in ways that could get them in trouble. So sometimes they're just going to be a pop for no reason, or a pop because they want to do that, or a pop because some forum decided that today Snapchat's their big thing. Like Wall Street Bets goes, all right, Snapchat's our thing today, and people buy it or sell it or whatever the case may be. But that's what I think is like possible for something like that. You could look for a stock like that. Now, I'm not saying this is the trade you have to make because I don't really like the short-term trade on it, even though you could afford it. But that's something that you could do. The other thing you could do with that money is like, so let's say you buy one of these contracts, like for argument's sake, let's say you buy the October at $12, right? So now you're working with, or let's call it 10, right? So now you're working with $90 instead of 100. So you could say, all right, I want to buy a little bit of crypto, right? So you could, if you have a crypto broker, or if you're using something like Robinhood, I think Webull does it as well. I never actually ended up signing up for Webull because I had so many problems getting my accounts to sync with it. And they ended up just giving up and going like, I got plenty of accounts anyway. I don't really need it, so I'm not going to mess with it. But if it has crypto, you could look into cryptos that have utility, not just any one that's going to pump, because there's going to be pump and dumps. And these charts that go to the moon and then never come back. Yeah, there's going to be those, and you could find them. But the best thing to do is look for a good crypto that's beat up in the same way. Right. So the Snapchat's beat up. If you're buying shares, I actually like shares more than options. If you have enough money to buy Snapchat shares, I would so much rather do that than try to buy calls or try to short puts or whatever it is. It would be so much easier to have something that doesn't have time decay. The fact that options have time decay is what kills you. It's why you have to think on super long-term horizons, right? Like I think on year plus contracts, or 30 to 90 day contracts, or 5-day contracts. I don't do 5-day contracts very often. I don't do weeklies. Never, ever do weeklies. So that when you do weeklies, it's actually effective. In fact, I did that. I used a weekly to hedge my bet, right? So I made an investment that the market was going to go up, but just in case it goes down a little bit more, which I think is extremely likely, I bought a hedge for a really reasonable price. And it was basically just a naked put, or a couple of naked puts for a small amount of money. I thought, all right, I'll take a little bit of my profit that I already know is going to be dinged and just buy this protection from going down. And it's a weekly because I'm making this trade within a matter of days. And now this weekly, it's dangerous because it could go to zero really quick. If it's not in the money by Friday, it's worthless. That's basically any option that isn't in the money by the time the date expires is worthless. That's why sellers have the advantage, because they sell the premium. 70 to 80% of contracts end up worthless So the sellers are ending up with all that money. They're making like 70% wins on those. Yeah, all right. I kind of lost my train of thought here a little bit because I was going on about a bunch of stuff. But what I like to do is find the beat up stuff. So you find a cryptocurrency that's been beat up as well, but has actual utility, not just something that's hyped. Like, look at what it's doing. Like, does it have a function? I've seen that there are coins that are going in like the energy market. There are coins that are working in the financial markets. They're working in the healthcare field, everything. If you find something that actually has utility and you research it and think, man, I actually think this is good beyond the currency itself, then that would be a good cryptocurrency to maybe invest in. But you also have to know a lot of these are going to be scams, or even if they're not scams, they follow the market, and the market is going to dictate whether these things do well right now because traders are already involved. And the mania from last year has subsided. People hate crypto now, so they're getting rid of it, and people are just kind of going into hiding and waiting for this all to settle. That's why I like buying in these environments. It hurts because you're going to buy and things are going to be down, but that's kind of what you have to do. As a buyer, you have to buy in downward markets. Downward movement is your friend. And if you can't take that, you're not going to do well in the stock market. So I like a stock like this. I look at, trying to buy shares. If you don't have enough money to buy shares, you could go for some leaps, some long-term calls. If you don't have enough money for that, then I recommend looking for something that you would be able to afford, or just being okay with losing a little bit of that money. So let's see. If you buy an option and it fulfills the strike price, you got the cons but before the expires, or it doesn't matter, and you get your profit. Hold on, I got to read that again. That's not making a lot of sense to me. Let's see. If you buy an option and it fulfills the strike price, you got the cons for before the expiration, or it doesn't matter, and you get your profit. I'm going to assume that you're asking if the option expires. It has to be in the money or more. Like, exactly. If it's a penny below the money, that contract is worthless. And if you bought that, if you went long on that contract and you're still holding it, you lose all your money. But that's the other good thing too. The max loss is whatever you paid for the contract. Sellers, if they're selling, their max loss could be infinite if they're going on the call side. So that's the one thing I do like about buying options. Even though it's not in your favor, your risk to reward ratio is a little better. And if you're not trading very often, then you can actually make a good amount of money and not get crushed by your losers. You type fast. Yeah, I know. Plus, the autocorrect and things like that mess with it. It's all right. If I didn't answer it, go ahead and try to reword it, and I'll answer it again. But basically, it has to be in the money, and in the money means the strike price matches what the stock is at or better, right? So if you have $100 call and the stock goes exactly to 100, that's technically in the money, but it's not. It doesn't matter. You're not getting any value for it because you could just buy the shares at the exact same price. So why would you pay a premium in order to buy the shares at the same price, right? So it has to be in the money a little bit. So let's say you bought the 100 and the thing went to 105. Well, now you've made a profit on that because you're in the money by $5. And the farther in the money you go, the faster your gain, or the more gains you'll have per dollar move of the stock. So you basically play the game of, as a long trader, you lose it all or you make a big gain. As a short trader, you're going to say, all right, I'm probably going to win this, but I'll make a smaller gain. The downside of that is my risk is much, much greater than the long options trader. If you have the stock that you're selling options on, then there's really not risk in it. But if you don't have the stock and you're selling options on something, depending upon how you do that, you could be taking on a ridiculous amount of risk to make a little bit of money. So I like looking for high premium shorts and ones that I don't like. I use a spread, which basically means you're selling one option and you're buying another to protect yourself from a move beyond that. Like if I sell the $100 call and the stock goes to 230, well, then I have to buy those shares at $230 a pop to give to the person who bought the call. Because that's what you're saying. Like if you have a call, what you're saying is, I think the stock's going to go up and I want to buy it at a certain price. I think the stock's going to 150, so I'm going to buy the $100 call so that way I don't have to risk, $50,000 to buy this stock or whatever you're spending on it. I could just put 1,000 or two down and still get the benefit of that movement. You're paying for insurance to buy the stock at a lower price if it goes up. However, if the stock does not go up, then you lose all your money in that option if you hold it till expiration. If you're a seller of that option and the stock goes up, you have to buy it to provide it to the person that bought it, which is high risk. But if you bought the call, then you really are only out whatever you put into that. So it's a little, you can sleep a little easier at night, I think, with long options, even though they're the ones that are more likely to get crushed. So you have to have kind of a specific strategy, and you have to work with them for a while. And that's why I like buying, using that little account size and just buying a little bit here and there, because it at least teaches you about what's going on. Because the best thing you can do as you get money over time is to invest it in dollar cost average in something. Find a fund that works well and just put money into that. Or if you're doing your own, look for you could ETFs, even exchange traded funds. The SPY is a mixture of stocks. It's a way to buy a basic market portfolio in shares instead of having to go to somebody and sign up for a mutual fund and do all these things and they're taking a commission. You could just buy the SPY, and there are commissions on ETFs, by the way, because people still have to manage those. You have to know what they are, but a lot of times they're not that much, and it's cheaper than doing something like going to an actual mutual fund. Although I think it's better to have a mutual fund than something like the SPY, because you have people that are diversifying more than that and know what to do, and will make the moves for you so that you don't have to go like, oh, do I sell? Do I buy? What do I do at this point? So what do you got? See, I'm trying so hard to understand this, but it's also hard. Yeah, it's going to be. So that's the thing. Keep at it for a really long time, right? Immerse yourself in it and make peace with the fact that you're not going to understand everything that's going on. That the best thing to do is just like swim in the water until you kind of pick up the lingo. Because when I started, I didn't know anything. I started by watching financial television, I like financial television. But at the same time, you also have to know that they have an agenda, and it can get you excited about things, and it's not the best way to learn everything. But what I do like about it is it immerses you in the lingo. It immerses you in how things work. It immerses you in the movements of the things that you're tracking. So you'll learn what all these terms mean, and over time, it'll just be ingrained. You won't have to think about, oh, I don't know what this is. I don't know what that is. But you'll get it. So just be okay with the fact that you're only going to get a little bit. I mean, your brain can only record so much stuff. I was watching something, I think it's like the hippocampus or whatever. You throughout the day, you're recording important information on that to save to longer term memory. But you have X amount of time that you can actually use, or X amount of space. Once it's full, you can't really add any more. So there's so much stuff to finance and to trading that you're not going to learn it all in a day or a week or a month or whatever. You're going to learn little chunks of it each day. You're going to go to sleep, and a good portion of that is going to get put into long-term memory, and then you can add another chunk. So you're going little by little. Brain literally hurts. Yes, it does. I tell you, that's the best part. Enjoy that hurt. Like, relish in that hurt, because it means you're making progress. Right? I know it seems like it's a lot right now, but over time, you're going to be making progress. And even if you make small gains here and there, as time goes on, you'll learn where those gains come in, and you'll learn what to avoid, which is the most important part. What do I avoid doing? Well, all the tempting stuff that you're going to want to do when you win a trade. So let's say you buy that Snapchat thing for $12 and it ends up going in the money on some random move. Like it ends up going from 10 up to 25 for like a month or something. You sell that contract, you make $100, few $100, whatever it is. You're going to think, oh, I want to do that again. So you start buying all these other ones that look cheap and good. And then all that money that you made just gets drained away by theta, because you buy them in short-term dates, because you're thinking, all right, I only have enough money to get the short-term ones. And those are the ones that are most likely to expire worthless, which is why they're cheap and why theta is so high, because they're going to be worthless very soon. And then you end up eating away all those gains and you're back to where you were. And that happens a few times as you start trading. So once you get into things and you make some progress and lose it, and make some progress and lose it a few times and kind of feel frustrated, know that has to happen. That's normal. You have to go through that process before you get to the point where you're actually making gains on a regular basis. And those gains aren't going to be what you think they are. It's going to be a whole different process. But after a while, you'll be so comfortable in it that you won't worry about it. You'll think, okay, I'm going to try to find as many income streams as I can, so that trading is only one piece of it. But as you gain money, you can eventually move more and more into trading if you like it. And if you don't like it, you can just invest, right? That's the beauty of it. You don't have to actually learn all this stuff and become some crazy day trader. You can just invest and kind of follow it for fun. I think that's one of the best ways to do it, because that way you're not too involved in the emotions of it and make bad trades because you feel, I have to make money. I didn't make money today. I'm going to chase something. That's how you lose it. So let's see. I think the smarter way would be the way you told me to trade stocks for now. Yeah, the best thing to do is start with stocks, right? Don't just buy a couple of shares of stocks to see how they move and think about what you want to do with it. Like if you plan on putting more money in there later, you can trade one share. Actually, I think the best thing to do is paper trade. So you can either do that on a computer or your phone or whatever, or you can do it on paper, which I actually started doing that at first. Like I took a yellow notebook and I wrote down my fantasy portfolio. I gave myself $100,000 and I said, okay, I could buy whatever I want. So I did some research. I looked into companies. I watched a bunch of YouTube videos. I figured out what I wanted my portfolio to be. And I rode that portfolio for, I don't know, a couple months. I wish I had done it for like a year before I started trading, or more than a year, but I wanted to get into it. I mean, that's why you're going. You're here to make money. You're not in the game to just sit around and wait. So that's the difficult part about it. But to actually be successful, you're going to have to do it. You're going to have to go through the mud, and it's going to suck for a while. And that's the thing. If you have more money, it's easier to make money. That's the sad part about this thing. It's the wonderful thing and the sad thing, because once you make money, then it's easier for you to continue to make money. But when you don't have money, that works against you doubly, because it's harder to make anything when you don't have that much. So just starting with stocks, paper trading, and maybe looking at what you could get on whatever broker you decide. So I see that on Webull, but never knew what it was. What did you see on Webull? Oh, yeah, paper trading. That's what you were saying you can do that. Yeah, the best thing you could do is paper trading. That's the thing I would do. I've been talking about this the whole time. I had all this stuff that I was going to talk about, but I've been mostly talking about what you do if you have a $100 account, because that's important. That's what I wanted to know. And I'm actually working on a series that's going to explain that. It's going to take a little while for that to come out, but I'm getting there. For right now, though, the stuff that I'm looking at is like Snapchat. And the other thing that I'm looking at here, let's go to something else. So we have to get into these stocks here, because I'm going to have to get out of here at some point. Let's go to ME. So 23andMe. Somebody, like, look at this, only has a few quarters of actual data, and it's all bad, right? That's what I kind of like about that. But the thing, let me put this on the weekly so we can see that a little better. Now, the thing I like about 23andMe is it's a legitimate business. Yes, it does have problems. It's still losing money, but it's got a lot of prospects. It has a deal with GSK, GlaxoSmithKline. So they're going to work on developing drugs based on genetics and things like that. And, they'll get close to half the profits for anything they actually made from the joint effort. So that's bullish. Like, maybe nothing comes of that, but if something does come of that, that's a 50% profit just throwing right in your face. What I like about it is it got beaten down so much. Someone brought it to my attention when it was like $2, like a little bit over $2. And I had looked at it before, but it was a new stock because it premiered in 2021. I was like, I'm not going to touch this thing. It's a brand new IPO. I have all this other stuff I have to learn. So I'm just going to, I was looking at it here around $2, and I started buying some longer term calls in it, some 2024s, and then it popped because the market popped and people were looking at this stock going, this is low. I mean, penny stocks are weird sometimes, but 23andMe is a legitimate company it's got prospects, and you could actually use their products, so it's not some random company that you don't know about. It's actually something decent. It's been beaten down to $2, and a lot of the risk was taken out of the stock. Because look at where it popped. It popped up here to like 13 a couple of times, like double topping before it coming down. But getting it at 2, if it goes from 2 to 1, that sucks. It's a 50% loss or whatever, but like, it's not going from 13 to 1, right? So there's way less risk in that. So I liked the long-term prospect of a cheap stock. The options were cheap. Buying it in the downtrend when everybody still hates it means that I could get them for a better price, and bam, they popped. I wish I had sold all of them. I actually sold, I think, one of them, right? I have a few of them in multiple accounts, and I was trying to add to the position. It actually popped on me before I was ready for it. I wanted to get way more and sell into something like this, but I didn't have enough when it did pop. So I was like, all right, I'm just going to sell a little bit of it here just to gain something back, which is great because, it tripled or quadrupled by the time I sold that contract. It was somewhere around $5, right? Or a little, no, it was more than that. Yeah, because that option, those options were like $30 when I was buying them, and they ended up going to between 90 and 120. So like, yeah, triple or quadruple the price. Was wonderful. I wish I'd sold more. But when the market started, took a little dive, it came back too, because it's still a penny stock. It still has the stigma of being, number one, a new company because of the IPO. Number two, a penny stock because it's below $5 and it's been trading at that range for quite a while. These are weekly candles, so you can see this is a huge amount of time to be in the $2, $3 range. So these little pops are going to come back when people are uncertain. And that's what I was saying about the markets. If we go back to the SPY and we switch it to the daily, so we can actually see that drop. Because things were moving okay. We're kind of sitting around, not doing a lot. There was volatility, but this was a huge drop, right? On Friday, it just tanked because Powell said, hey, yes, we've had a pump since that July meeting, but we have to keep prices down. So we're not going to turn rates back. We're going to continue to pump rates up, which is the important thing to look at. Like the Fed is controlling the market right now. We know all the other risk factors, but the big one is, what is the Fed going to do? So they said we're going to continue to be harsh, basically, and the job market is probably going to suffer because of it, which made people dump stocks. Because if the job market suffers, that means that these companies aren't producing as much stuff. They're not taking it. They're not going to be making as much revenue. They're not being as active. They're dumping jobs because they're worried about a slowdown. And people holding the stocks think, all right, if the companies are worried about a slowdown, I need to get out now so the stock doesn't come back down and erase a bunch of these gains that I have. So we had a bunch of panic selling for what people think is the next leg down, which it might be. That could have been the start. This was a nice little ride up, and I think people kind of got complacent, not realizing that the higher the market goes, the more likely it is that the Fed is going to tamp down even harder on rates. I've been using the saying for months now, anything bullish is bearish and anything bearish is bullish, because the more something pumps up, the more the Fed says, okay, there's too much money running around in the market. We have to tamp that down because that is a problem. All that money running around in the market is what drives prices up. It allows commodities traders to drive the price up of anything because they have more cash to be able to do so. And the people that have the cash will be the ones that make the big trades that make money. You know, everybody else is just kind of following on the coattails. So you see somebody come in, inflate a market extremely, and then that cost gets passed on to all the businesses that have to buy that stuff and the consumers that have to buy from those businesses. You know, so the Fed is saying, all right, I don't want the money in those markets pumping up everything, pumping up fuel, pumping up food, pumping up rent. I mean, they're trying to get the housing market down. There's so much going on. So as this rally was going, the Fed was saying, the higher this goes, the worse it is, so we need to go harder and harder. And he basically told us that. He said, all right, you know, things are getting a little complacent, but beware, this is going to hurt. So people finally went, all right, it's time to take some gains, and we may have another leg down. So I want to see what happens this week. I'm in cash for a good portion of my trades because I'm not really sure what's going to go on, you know, and I'm more of a long side trader. I do go to the short side. For example, Bed Bath & Beyond, which I'll talk about next when I'm done with this. But mostly I'm looking to get these because look at how long this lasts. You know, bull markets go for a while. Everybody thinks they're over because they have these little like, oh, I'm over. Nope. Oh, I'm over. Nope. Oh, no, I'm definitely over. I'm definitely over. It's probably going to be a nope at some point. But is the nope here? Is the nope here? Is the nope right where it is? You really don't know. So I'm going to be watching it and seeing what it's doing and waiting for my opportunity to go long again. Because once everything lets up and things return to normal, the market will continue to function. The Fed isn't getting rid of inflation. Inflation, in some ways, is our friend. Inflation increases the value of everything we own. It's why retirements are worth so much. It's why it's important to have a retirement account, because if you just let inflation pump that up, then you don't have to do anything to make that money. Instead of using that money to do so, like, oh, I'm going to buy a dirt bike and then go crash it into a ravine, and then that was, you know, a waste of $5,000 or whatever. You could have put that $5,000 into the market and turned it into $25,000, $100,000 in however many years, right? But instead, you bought the bike that's in the ravine, right? And then you don't walk right anymore because your knee is messed up from it. So what are you going to do with that? Are you going to sit there and blow it on something, or are you going to actually try to put it into something that can generate you money? And that's what I've been doing with this. I think about when I go out buying things, I'm like, all right, do I want to buy this or do I want to buy 5 shares of whatever company? You know, it's like that's really your thing. And even when you're getting down to like $10, man, like there are times where I'm like, all right, I could buy, you know, this $10 snack right here, or I can buy a share of Snapchat. Literally, I think, like, would I rather have a share of Snapchat or a freaking candy bar? So that's kind of how I think about this stuff now, and I'd rather have the share, to be honest, because once you eat the candy bar, it's done, and then you get mad at yourself and you try to get rid of the calories you consumed from it, so it's worthless. Basically, you're just trying to get a momentary hit of pleasure, and then you have to pay for it in all these other ways. I'd rather have the money pay me in all these other ways instead of having to pay something else. So that's why I'm thinking about that. Like, all right, do I want to buy a hamburger, or do I want to buy a share of Snapchat or some shit? So yeah, well, we've got some movement. I'm not sure what's going to happen, so I'm on guard right now. I'm in cash because the Fed could tamp things down harder. If this reverses, here's the thing that I'm worried about. If this really big drop reverses and it continues to go up, the next Fed meeting, which is coming up, I think September 21st. So be ready for that. That's what the market is waiting for, is the September 21st rate announcement. And by then we'll have more economic data, and we'll see if the Fed's going to go harder with rates, keep it about the same. What are they going to do? Because the harder they push rates up, the worse that is for the market, and the longer the market's going to stay down. So that stuff is extremely important to pay attention to. The other thing that's going on is the Fed basically said they were going to reduce their balance sheet, right? So what they do, I was talking about buying that bad debt. It's not all bad debt. They buy bonds, they buy all this other stuff. But the two things that they were talking about reducing were treasuries, which are bonds from the government, and mortgage-backed securities, which are basically bundles of mortgages that have been turned into a financial instrument. Is like one specific thing. So they were supposed to sell, or I should say get rid of, about $17 billion worth of mortgage-backed securities every month starting in June. And then when they got to, I think, September or August, they were supposed to ramp that up to even more. Well, up until recently, the Fed has been adding mortgage-backed securities. They've been selling the treasuries, like they said, but their mortgage-backed security holding has been going up since June. Now, I haven't checked the readings. I completely forgot to check before the stream. I mean, maybe it's down now, but when I checked it not that long ago, it was up. Their mortgage-backed securities were up by like, I think 3 or 4 billion one month and like 8 billion another. So instead of reducing by 17, why are they buying? And that's my question. Every time I look for that answer, I don't see a lot of information on it. So I'm not sure it's something the Fed really wants to talk about. I don't know if they've addressed it on the Jackson Hole meeting because I haven't had a time to go through the entire Jackson Hole thing. There's just tons of information to go through. But that's important to me. I want to know what they're doing because the housing is coming down. Like everything is coming down. What the Fed is doing is actually working. The reason this drop happened is because the Fed said we need to do this. It started over here in May, right? Or March, sorry. It started somewhere around March. This first pump right here was the squeeze after the rate announcement. So they basically for the first time in years, they raised interest rates. That hasn't happened in years. We've been in an environment where interest rates have either gone down or stayed at almost zero. So money could just come into the market and pump things up. Now it's a different story. Every time they tamp rates down, it's more and more expensive. It's more and more difficult to get that money. And it's making it harder for the traders that pump the market up to continue to do that. It's making it harder for everybody, but it's really hitting the traders that are moving this stuff more than it should be. Like the futures market, everything like that, the derivatives market makes everything else move. Because here's the thing that people don't realize about the derivatives market. It's based on underlying stocks. So these companies, if they're going to sell these derivatives, they need to hold the stocks as collateral in case the move goes against them. Because if you own a stock and you sell calls on it, the worst thing that could happen is you could sell the call for a profit. Right? If the call doesn't go in your favor, you get to keep the premium from that call and you get to sell another call. So let's say you make $200 on that and it doesn't go up. Well, you still have the stock and you get to keep the $200. Then you get to go and sell another call so you can make another $200. And if the same thing happens, you just keep selling calls and collecting that premium on stock that's just sitting there. And if the stock does go up to the point where you sell the call, well, you pick a strike that makes you money when you sell. So it's like, all right, maybe I bought it for 100. I sell the 120 call. So if the thing goes above 120 and I get exercised, I get to keep the premium. Plus I get to sell my stock for a $20 a share profit, which is nice. So these companies will buy stock in large amounts, which can move the market. I mean, some of these big moves are these large institutions, these large firms hedging their bets against the smaller traders. They buy these stocks, sell the smaller traders the call, and then collect the premium as most of these calls become worthless very soon. But if it goes against them, if Jerome Powell comes out and says something, or Janet Yellen says something, or some company has some breakthrough or whatever, you have the ability to cover that and sell at a profit. And the other side of that is the market moves. So some of this is people think it's going to change. The market direction is going to change. So they're switching to different stocks. And that, I think that happens with every quarter, every option cycle. So you see these red lines, these are contract expirations. And you can see a lot of times things change direction at those expiration points because it's a new set of stocks. Maybe somebody bought these or whatever and they made a bunch of money. So they're getting rid of those and they're trying to get into something else because they think that the move on this is over. So it's a repositioning will move. That's why there's a gap. Look at this gap, right? People think something's going to happen. Plus all these giant firms are hedging their bets, right? And then there's just the regular movement of the market. So you'll see that at these contract lines, things reverse. And we just hit a new contract cycle. It's only been a few days, like 1, 2, 3, 4. This was the first week of the September contract cycle. So things are bound to be volatile and change directions a little bit. I mean, look what happened here. It was basically flat. And then the next contract cycle, it was up, right? When this one, it was really volatile. It started in the middle, popped up, came down. But where did it switch directions? At the contract cycle change. Where did this downtrend stop? at the contract cycle change. So it's a chance for things to move. So volatility right at the beginning is common, and I expected that. The other thing we need to be aware of is it's September. And anybody that's been listening to this long enough know that September is the month where things go crazy. If you look at the historic, let me back up on the SPY real quick. We can see when things got crazy. Am I still in the daily? Let me switch it to the weekly so it's a little bit easier to see. So this is the S&P over a number of years. You can see in September last year, right here, there was a downtrend, right? We had everything was going up. It was just continuously up, 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 up. But then where did it switch directions? September 1st. Which happens over and over again. And then it kind of reversed itself in October, which kind of happens a lot too. So what happened? Let's go back a little bit farther and look what happened in the previous September, right? So that was the year of the pandemic, the huge drop, right? So we had the giant drop in May, and then the rally that nobody believed was going to happen, which is why things got kind of crazy right here. And what happens when you get to September? The same thing, huge volatility. You think, oh, that's interesting. Why does that happen? Well, September is the month where things return. Basically, a lot of traders leave for the summer and they come back in for the last quarter, maybe the end of Q3 or something like that, but definitely going into Q4. And September is also the month that the United States government's budget switches over. So I think there's a lot of volatility because big government contracts change around that time. So stocks related to those contracts will also change. And you'll see they're not always like this. So don't think every September is always going to be like this. But as long as I've been trading, September has been a weird month. In fact, let's go back to 2019 and look at September. All right, there was volatility already going into September, but look at that. There was a downtrend for a few weeks, right? September hit him again. That's 3 years in a row that September has been a downtrend or at least a really crazy sideways volatile move. September of the year before. Now that one is a little different, although it did peak at the end of September. So this one, all right, going back to is this 2018? Yeah, so going back to 2018, this one wasn't quite as crazy. It's just likely that stuff happens in September. It doesn't always happen. So you can't be like, all right, it's definitely going to happen. I'm going to position myself like it does. September has a lot of movements. There are a lot of things that change. And we've seen a lot of budget talk in the politosphere. So I think September is going to be a volatile month. Not to mention we're already in a downtrend. So that continuation is probably going to be in people's minds. And they're going to try to get out and move during that time. Hey, we got a first time chat. Don't forget the triple witching. Yes, that's the other thing I was going to talk about. Thank you for bringing that up. Jukebox 88. I appreciate that because at the end of each quarter, you get triple and actually even quadruple witching now. But what that basically means is like the big contract cycles for certain industries are going to expire at the same time. So there's going to be huge repositioning. And these are quarterly contracts, right? These aren't weeklies. These are where the big money players are adjusting their position. So even though triple or quadruple witching doesn't always cause a move, it can. So September is another month where that happens. So we have all this volatility. We have the United States government changing everything in September. We have quadruple witching happening in September. And we have people prepping for the final quarter of the year in which things kind of go crazy. Because there's something called a Santa Claus rally and there's tax loss selling. Those two come into play together sometimes at the end of the year. And I think on a downtrend, you have a much better chance of getting a good tax loss harvesting year. Because one of the first years I traded, the December drop was crazy. People were getting out of stocks like mad and everything was super cheap. So I used that as an opportunity to buy some things at a really good price. And the next year, everything popped. So if you go back to that time, huge volatility. So this is when the trade war started, and then this is when things started getting out of hand with interest rates. You can see massive volatility around that time. But this drop right here, when you get to the end of December, you can see when does it switch around? 2019, right? This is where the Fed came in and said, all right, we're not going to be raising rates anymore. And in fact, I think they may have even lowered them a little bit. I can't remember. They either lowered them here or they stopped raising them, and it pumped the market like crazy right after that. And people who were down on their positions, because the year started up, right? If you go back to January, so where's January? So the year is starting somewhere around here, right? So this green candle, actually, this is the first week of the year. Boom, bullish, right? We're starting up around 267, but the year ended down at 240. So people are down and they're thinking, I might as well get rid of these bad positions and take a loss on them so that I can write it off on my taxes, right? So big traders are getting hit hard with taxes, and people that hold stocks for more than a year, have a different tax structure than people that hold stocks for less than a year, which is why sometimes at the beginning of the year, you'll see repositioning because people that have been trying to stay for longer than a year in order to be in that capital gains tax bracket can actually move now, but they've been locked up. So they don't want to do anything until there's, number one, enough liquidity, i.e. enough shares changing hands for them to do something, and two, a reason for them to do it, which would be that tax loss harvesting on their taxes. They can say, I lost money on this stock, so this other one that I gained on, I don't have to pay as much in taxes. It kind of offsets them. So if you want to hold those positions and keep them going, even though they're losing, that's one thing. But if you sell them, you can take some of your taxes off the table. And then if you want them, buy back into those positions later. Right. So that's why you'll see these crazy drops. And I think tax loss harvesting only seems to happen to an extreme on years that are down, because most years I've been trading have been up. This was a down year, right? So this is where I think tax loss harvesting was its best. I haven't seen a December like this since. Then you move up to the next one. What happened here? This December was all green, right? There was no tax loss harvesting. I was hoping at the end of the year there was going to be, but nope, it was just up, 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 up. And then we ended up having the pandemic next year. But you can see the same thing kind of happened. When at the end of the year, was there a big tax loss harvesting move? Nope. It just kept going up. So I think the reason was because these were up years. There were a lot of people weren't down on stuff. Most people who were just buying random stuff in the market were making money. You didn't have to be a genius. I mean, there were these TikToks that were like, oh, all you have to do is make money is you just buy a stock, and when it goes up, you hold it. When it starts to go down, you sell it, which is stupid advice. It's terrible. But at the time, it was good advice because it actually worked. I mean, people could do that. You could buy dumb stuff and it was beneficial. I don't recommend doing that. I think you should buy good stuff because good stuff performed even better, because it's good. It has a reason to perform better. It should perform better. So, but when the year's going up, not as many people are down, so they're not going to sell their down positions, thus driving the stock down even further, which is what I like about those. Like, I want a down year to see if we get a good tax loss harvesting December. But we could also have a Santa Claus rally. Sometimes things go down, because I think that's what happened that year in 2018. I think it actually started to go up the day after Christmas, because there was like a really low day right before either Christmas Eve or the day before. And it was a huge red candle. I was looking at stocks over Christmas going like, wow, these are cheap. I want to get in on some of these. And I think I bought a few of them. And the next day, everything was sky high because it started to bounce. It wasn't like tax loss harvesting season lasted all the way to the end of the year. It lasted until Christmas, and that was it. So it's not like a hard and fast rule where you have to say, all right, it's definitely going to happen at this time. Because also, talking about quadruple witching, the end of the year is yet another triple and quadruple witching. Once every quarter, at the end of the quarter is when that happens. You get quad witching 4 times a year. So you can kind of count on volatility: 1 from the end of the year, 2 from quad witching, 3 from tax loss harvesting, 4 from a Santa Claus rally. And the Santa Claus rally thing I bring up because it's more of a mental thing. People think a Santa Claus rally is going to happen, so it happens, right? So that's what you have to look for: is, are the traders going to make that kind of stuff go on, which they may this year, because this is an extremely volatile year. And we started here, we're down here. There's likely a reason for people to dump a bunch of their losing positions when we get into December, which I love. So December would be a wonderful time as long as the news is still bullish in the long term, because you have to pay attention to like, what's the long-term view of the market, like 6 to 12 months out. That's what these stocks are pricing in. They're pricing in a move in the future. So is it worth it, or do you think it's going to crash a little bit? And is the environment going to hold it up? Because that's the important thing. If you're going long, you need the environment to hold you up. And you can get that with these drops. With these tax loss harvesting years, that's a great time to get in on some of these stuff. I'm really hoping we get a nice drop. This pump, though, shows me that the market does have strength, because fundamentals are still there. We keep talking about a recession as more than just the 2 quarters of GDP. It's become like a political issue, but from an actual standpoint, there are multiple definitions of recession. There's like the technical one where it's down for 2 quarters, and then there's the one that has to do with everybody's quality of living. Are we in a recession because it's really hard for people to make money? Prices are way out of control. What's what's going on there? We have inflation, but we have a really high employment. We have good spending. We still have somewhat strong investing, but it's been coming down because of the Fed. We still have strong housing, even though that's coming down. Inflation is starting to come down in some figures. Like oil is down a bit. Housing is down a bit. Is it going to continue to go like the CPI is down about 1% from where it was, or 0.5% from the previous month? So that may be the peak, but that may not be the peak. You really don't know. Part of that was what set this up. The Fed said, all right, things are looking good. or right over here. I'm sorry, the CPI coming over here that continued the rally. The Fed said things are looking good, started the rally. Certain numbers came out, like the CPI, which is a really basic measure of inflation that the public and the Fed look at to justify their moves. Pumped it up a little bit more because it came down a little bit. Now, if that number is higher next month or this month, whatever, yeah, it's next month because we're still in August, then that could drive the markets down even farther. So the market is looking at the data. The Fed is looking at the market and the data, and they're all reacting to each other. So the farther up the rally goes, the more the Fed is going to tamp things down. And the more the Fed tamps things down, the harder the drops are going to be when the rallies end. Because the rallies start because of squeezes. It's mostly a short squeeze that gets things going because people always bet against this stuff. The bears think the world's over. They listen to Peter Schiff. Although, listen, Peter Schiff, he knows what he's talking about in some ways. He's a smart guy, but he's selling gold and he's trying to spread FUD. That's his thing. He makes money off of that. And there are so many people like him. I always use him as an example because he's popular. He's the one, if you go researching stuff on YouTube, eventually you're going to come into one of his videos where he tells you that the next 2008 is coming. It's going to be worse. The dollar's going to collapse. And the only way you're going to survive it is buy gold. And by the way, I have some gold, but everything's going to go down, so you need it. It's in his best interest to make you scared. It's in his best interest to make you bearish. And people like him spread that kind of stuff. And when we come to a Fed meeting, the bears go, all right, this is it. That thing that Peter Schiff or whoever it was talking about, it's going to happen. Everyone's going down. They just don't know it. I'm going to short heavily. They do. It never ends up being that bad. They get squeezed out, and then the bulls come in and continue the rally. So a short squeeze starts it. The data and the Fed, actually, I should say the data and the Fed start it. The short squeeze provides the fuel, and then the market provides the direction until it runs out of steam, which it did right here after this first rally, because companies started reporting and they were guiding down. They were saying, all right, our numbers are okay for this quarter, but in the future, they're going to be lower. So that scared the stock market and it started to go down. And we started having rate increases go up higher and higher. Like we went from a 25 increase right here, a 25 basis point increase, which is 0.25%, to a 75 basis point increase down here, and then another 75 basis point increase down here. So we're up at that range that we were at the last time the market thought this was too stressful. And we're trying to double that range almost by the end of the year. So that reality is going to weigh down on stocks as soon as the short squeeze and the bull run stop. Because eventually reality is going to push this stuff down, and there's going to be less money for the companies to do what they want to do. There's going to be less opportunity, less buying power. There are going to be fewer sellers of things that they need. They're going to have to pay more for stuff, or certain things aren't going to be available. Whatever it is, it's going to affect the market in a way that will drop their forecasts, which will drop the stock, because the stock is forward looking. It doesn't care that much about today. It cares about 6 to 12 months in the future. If a company says next year our earnings are going to be up by 20%, the stock will move probably by more than 20% because it is anticipating that, and people are riding the back of that. Like there's always the people that are early to the event, and then there's everybody else that comes in later. And the everybody else coming in later part is the part that really moves it. The first comers end up getting a little bit of that movement, and then the market pumps it up even more. So, but those latecomers get out when things look bad. So we've been pushing out a lot of these latecomers, the weak hands. People are going out of the market, and when things start to go up, they start looking at it and wanting to come back in. And I think part of the squeeze was people that got out of it somewhere down here were looking at it like, oh, it's getting away from me. It's getting away from me. So they start buying in right here, and then look what happens. Right. So they get frustrated because this cycle happens. They think they're missing the bull run. They start to buy in, they get crushed. They think they're missing a bull run. They buy in, get crushed. And after a while, they just don't want to do it. They can't take the pain anymore. So they leave. And that's not the way to do it. You have to buy little bits and expect it to continue and be ready for it to go the other way. And if you think, all right, if it goes the other way, I'm good. I want to hold this, or I want to sell it at this price and just stick to your plan. But a lot of these people, they just buy it. They don't know what they're doing. They never sell it, and they lose all their gains, or they buy something stupid that comes back down quickly. But after a while, when you learn about different companies and how they operate, you'll find ones that you just naturally like. You know, like some of my investments, I like Verizon. I've been buying Verizon. I also like the cannabis sector because it's so beaten up, and it pops on little things like legislation, which is on the bill. So I've been looking into those kind of plays. But the downside is cannabis has been destroying me. A little bit has been coming back. The market pumping has actually helped a lot of my positions because as it was going down, I was averaging down and changing where my positions were. I was trying to go farther out in time with the options and trying to close out some of these shorter term ones and move it into something that had a little bit more staying power. And now that I did that and the market's come up a little bit, that's benefited me. I've regained like 20-30% of my losses on that cannabis position, which is wonderful because it's been a huge loss, man. I've been doing all these little trades and winning a pretty good amount of them and actually making a decent amount of money. But this cannabis trade has eaten into those profits like crazy. I'm still up, but not anywhere near what I would be if I hadn't been buying in and when I started to buy in. So that's what I've been looking at, just little stuff like that. You can buy into stocks that you like on dips and then write them up. And if you don't want to keep them, you just have to decide where you want to sell them and stick to that plan. Yes, you're either going to miss out on gains or you're going to set a target that's too high and the thing will start coming back and you'll feel bad. But if you're a long-term trader and you think it's going to go up, don't worry about that. Think about the long term. Have faith in your decision. If you've done the due diligence, if you've looked into it, just be patient with it and don't put any more in than you're willing to lose. You'll be all right. If you do lose, it'll be a lesson. That's why I say don't put too much in, because losses are extremely valuable lessons, and learning how to cope with them and come back from them is what keeps you in the market, which is the important thing. So what do we got down here? What is your opinion on the current VIX term structure? I'm going to switch over to VIX real quick. Let's take a look. If I trade the VIX, I'll use something like UVXY, one of those like mildly leveraged products. But I don't like trading those because they're extremely difficult. If you're buying into them, trying to get the contracts you want is ridiculous. And if you're selling them, it's hard to use spreads to sell those things because you're not going to get a lot of premium. The people that trade this thing are sharks. They know exactly what they're doing. Little intermediate traders like me don't really stand a chance to go crazy with it. So what I like to do is wait for huge spikes in volatility and then short calls with spreads when there's actually enough premium to justify that, because that's long term. Like there are a lot of traders that say 45 days or something like that. With the VIX, I might even go a little bit farther than that if I'm selling premium on it. Not all the time, because look, these drops are usually relatively quick and you don't want to be so far out that you don't get the gains from that drop using a spread. But going out a few months or something at the very least for me is what I like to do, if I'm going to do that at all. But a lot of times I won't play the volatility just because it's such a difficult game sometimes. I like playing the stocks that I know a little bit better. But volatility can move a lot, and it's worth, and it can make you a lot of money. So, I mean, if you're good at it, it's worth looking into it. But right now, I think since volatility has gone up, it might continue to go up for a little while. I think shorting calls as this thing moves up a little bit, it's probably what I would end up looking at. Maybe buying puts if you really wanted to do that. I'm not, but UVXY is usually the one that I use just because I know that product. But I'd probably be selling calls into it and just kind of waiting a little bit, hopefully taking my gains around 50%. So what do we got? Let's see. I prefer using contract expiration last price as an indicator of appetite for risk and cost hedging rather than play the directionless plays. Pretty hard to pull off. See, there you go. Exactly. That's the kind of thing that I like to do. If you're trying to go with a direction in VIX, it's so much more difficult because that's how they lure you in. They get you to buy those long contracts and then you get crushed, right? If you have the stomach for it and you can sell those contracts, that's the way to go. So you're using contract expiration last price as an indicator of appetite for risk. So let's see. So what do you mean by that? Are you saying that the last price of which contract? Like, are you looking at short-term contracts, long contracts? Or are you saying any contract and any given time, like the last price at middle of the day or the last closing price? Because see, this is what I want to. Other people that trade options have slightly different strategies. Mine's like a little bit weirder because I combine the short and the long sides. Like a lot of the shorters don't ever want to go long, and a lot of the long people don't ever go short. But yeah, so monthly. Okay, you're using a monthly close, and you're saying appetite for risk for the next contract cycle. That I like. All right, if you're just saying that on any contract, not necessarily on the VIX, or are you specifically talking about the VIX? And if you trade the VIX, are you trading VIX futures, or are you trading one of these other stock products like UVXY or something like that? Because that's pretty much all I've had experience with is UVXY, and not so much the actual option or the actual futures that go with that. But I like watching the VIX because, I mean, look at this. This is a perfect explanation of humanity right here. I actually owned long shares in VIX at one point in time. I was buying them down here before the pandemic, and I forgot that I had them in this account right here. So I only had a few shares of it. I was just kind of like, all right, I'm going to buy a few in this because I'm messing around and I want to track it on my charts. So I bought like 5, 10, 20 shares, 30 shares. I don't know. It was like a really small amount. Forgot I had them. And then in the middle of, or like towards the end of the drop, I looked at them and they were at like $90. you know, so I dumped a bunch of them, and then it went up to about 120, and I dumped the last of those really close to that price, which was awesome, like right before it fell. So buying long UVXY or long volatility products is so dumb. It's not the way to go. If you do, it's got to be like an overnight trade or like a really short-term thing. And it's got to be like whatever, you have to be okay losing whatever you put in, because those things can crush you quickly. But if you can get them at the right time, sometimes they can be profitable, man. That's why I'm saying, like, never trade. Like, when I say I never trade 5 weeklies, I just never do it. So that way, when I do it, it's not so bad. It's the same way with the VIX. I never trade the VIX. So that way, when I do trade the VIX, it's not so bad. I can actually do something on it. So yeah, example, VIX futures, September 22 contract versus the previous contract. All right, so you're going like 30 days out. And are you selling those contracts, or are you looking, I'm guessing that's what you're saying. You're trying to sell them now. And are you trying to trap it like with something like an iron condor, or like an open one, not necessarily a closed one? Or are you trying to say like, all right, I'm shorting calls, I'm shorting puts. What are you doing to actually play the next contract cycle? Because I'd be interested to see, or to hear about what that is, considering, you know, I don't get it. I've been streaming for a few months, and people come on, and not a lot of people come on and actually talk about options. They're usually either newer traders or they have a little bit of knowledge. So if you're actually trading those things, like, I really want to know what your strategy is, because it would be great to add that knowledge to my own knowledge bank. Like, I want to learn from everybody that I possibly can. So like I said, my strategy is more sticking with the stock products, stock volatility, maybe some crypto, but going long, short, and going for things like iron condors, and going for straddles and sometimes strangles. I really don't like strangles, but I usually only do those if I'm going long. But like a straddle is a great strategy I like to use sometimes if I have the cash open for it in my trading accounts. So let's see. We're talking about the VIX here. Let me flip over if you're responding to that right there. Let me flip over and take one more look at the market, because I have to start winding things down. What are we doing on time? Oh yeah, 5:10. I need to start winding things down here a little bit. So I didn't get to my trades yet. All right, so real quick. Oh, here you go. You responded. So if you want to play it directionally, I'd say calendar spreads. See, okay, there you go. And something to look into, but I don't trade them. I just pay attention to it, and then I look at the implied volatility percentage on stocks I care about to sell covered calls. Oh, there you go. Covered calls, my absolute favorite strategy. That's what I want to do. It's just a tool to decide on direction, basically. Yeah, see, that's my ideal strategy, is honestly the wheel. And as I build, and I want to play the wheel on really good blue chip stocks, because I know how they move now, and I've been watching some of them. So as I add profits to my trading accounts, I want to move more and more towards buying the shares in groups of 100 so that I can sell covered calls and do what I was talking about earlier. Just collect premium until I either sell at a profit or get hit by the shares decreasing. But here's the thing. I want to buy stuff like, you know, when I was talking about Snapchat that's already beaten up, right? So let's go back to Snap, SNAP. This is one that I probably should be. I only have contracts on it right now, but I would love to buy the shares down at this price in case we start flirting with this $30 level again, which I think is extremely likely, considering it's down because of a lot of factors, but it's a little overdone. I mean, it can, I don't think there's anything stopping it from going lower. And if the market goes lower, it will definitely drag it down with it. But I do think there's a good chance that it could bounce. So selling covered calls on something like Snapchat would be okay for me. But like, I really want to sell covered calls on blue chip stocks, because those are the easiest thing to move. Any indexes too, actually. I'd rather sell covered calls on like the SPY or the NASDAQ or something, because those move even more in a rhythm with what you can actually trade. All right, so yes, no, Snapchat would be something I'd look at if I wanted to actually sell covered calls. But yes, that's the strategy I like, the wheel strategy. Selling puts on something until you get exercised, if it's a stock that you actually believe in and don't think it's going to go too much lower and are okay going in at that price on. And then selling covered calls until you get exercise. Like, that's, to me, the absolute dream strategy. I'm using spreads and all this other stuff because my account size still isn't to the point where I can do that. Like, my long account, it has enough money to do that, but I don't want to do that with my long account. My long account is going to stay where it is. My two trading accounts are going to stay small accounts for a long time until I'm comfortable adding a little bit more money. And I'm not that comfortable yet, because that huge loss that happened a couple of years ago still haunts me. You know, like, it was really bad. I gave up for a long time. Like, I thought I knew enough to not have that kind of a problem, but I ran into a situation where I could have made life-changing money. And literally at the last second, like the last couple of days before the deal was about to go through, another company came in and swooped it up, and it was all dead. Boom, gone, everything just like that. So, I mean, and it took a long time for me to be okay enough to put that much of my money into an account. Now, I didn't blow up. right? But it was a good chunk. It was like a third of all of my money. It was disgusting. It just hurt so bad that, I had to change my strategy, which is why I use spreads and I use small account strategies. And I'm going for wins in the $100, in the low thousands. Like I'm going between like $100 a win and $2,000 a win. That's my range right now. I mean, if I make more than that, wonderful, but I don't want to risk the amount it takes to make more than that until I have enough set aside to be comfortable doing that. So one of the things I did was I traded Bed Bath & Beyond. Before I go on, I'm going to finish your comment here. You said, yeah, I got burned with leverage, cost of tuition. This year is my turnaround profit. Yeah, see, that's the other thing too. I don't use leverage. So I'm moving slowly. I have a small account. I don't use leverage. This is not the trading profile that a lot of people want because it's not a recipe for quick gains. You want to be a millionaire next year? My strategy is not going to work. You're not going to be that rich anytime soon, but you're going to stay in the game. You can use these other strategies that might make you a millionaire, but you'll probably quit because you're going to lose so much money. It's going to mess you up mentally, like really, really mess you up. Some people go insane because they have problems in the market and they lose a bunch of their money. I mean, there was a story a couple of years ago about a Robinhood user who thought he was down like 700 grand, only having like, I don't even know, 30 or 40, 70, something like that total in his account. And he committed suicide because he thought there's no way he could pay it back. Turns out it was an error. So people get really messed up on this. This psychologically is way harder than anybody who doesn't trade or invest understands. Even if you're good at investing and good at trading, it still hurts. Like watching your profile get beat up during these downtrends is awful. It's absolutely awful. So you have to have the stomach for it and you'll learn how to do it. So what I do is I make these trades. Finally getting to this after saying I'm going to forever. Bed Bath & Beyond. You probably already heard about the story. I was shorting Bed Bath & Beyond somewhere around here, right? So I got into it. We had the nice drop after earnings, and I got out of it. I don't usually hold things over earnings like that, but I was very confident in this one. I mean, I had made money on the short. I took some gains, rolled things over to a better position, and then made the nice gains on the drop. So once this started to pop up, I gave it a few days. It was up, somewhere around here, like 12, 13 bucks. I thought, all right, I'm going to get into this thing again and short it. So I shorted... Actually, I bought puts. I was confident enough in this to buy naked puts on this thing. And what happened the next day? Ryan Cohen, I think is he the AMC guy or the activist investor Ryan Cohen comes in and says, "Hey, or he files his Form 13 or whatever it was, saying he bought all these shares." So people, the meme stock world, the Wall Street Bets crowd pumped it up, and it was highly short. The float was like 40, 50, 60% short, which is insane. If you're going to look at a stock, make sure you always check what the short float is. If you're thinking about going short on a stock and everybody else is thinking the same thing and there's like 30% of the float is short, don't touch it. Like that is not a stock you want to short. You want to go for something that's people aren't thinking about and you're more confident in when it's showing signs that it could break down like this. Like Bed Bath & Beyond is really volatile. It pops, but it usually comes back down because it has problems. It's a brick and mortar retail store competing with Amazon, who is continually taking more and more business, taking more and more market share. There's a reason this thing should be down. I mean, they got a loan, so they got propped up a little bit. But when Ryan Cohen, Mr. Activist Investor guy, comes in and says, hey, I bought all these shares, it pumped the stock. But you know what? He sold into those people because right as the stock was going up, he filed a form that said he sold all of his shares. And this was at like $28 from $5, $6. Yeah, it was like $6, pumped all the way up to 28, or let's say 30. Oh, wow, this was above 30. So it pumped up to $30 or just above. And then the dude said he was selling, which crashed the stock. So my put went from being about 50% destroyed, or my puts, I'm sorry, because I had multiple plays on this in different accounts. And I was buying close to the monies too. Like I was buying these 40, 30 delta puts, it was insane. So these things got absolutely annihilated when it went up here, but it came back and bounced down low enough that I was actually up a good 10, 20% on those things. So I could have made more if I'd waited a little longer, but I sold it right before they got that loan and popped back up. And that was such a lucky play for me. Like this would have been the time to be shorting it if you were going to short it, not right here. Normally this would be it, but because of the whole Ryan Cohen thing, the squeeze went out of control. But I wasn't paying attention to the short float. Right? I was paying attention to the fact that it's Bed Bath & Beyond and it's up. And I've been watching it for so long that these moves, like I short these a lot. I think I hit this one too. I might have even hit one of these over here. I remember one of these really big, giant return candles. Like, I hit one of these dead on with Bed Bath & Beyond, and the same with Rite Aid. So, like, this is one of those stocks that I'm not too shy about going in or leaning into it if I need to. But this one could have been really bad. If he hadn't filed that other form, those puts would have been absolutely destroyed. It was not the right play to go at that time. However, I got lucky and came back. So that was amazing. I mean, it was great to see the thing down 50% and then see it up like 20% and go, all right, I'm out. That's great. That was wonderful. So that was my big trade during the last couple of weeks. The other good one that I did, which was a day trade that I could have actually held a little longer, was ConocoPhillips. So they had a couple of bullish events that I knew were going to be good day trades, which is why I went for it. I actually went for the 5-day weeklies. Do you know that whole thing about never buy weeklies so that when you do buy weeklies? Well, this was the when you buy weeklies week. I got it around 96, 97. They had some news that, number one, OPEC said it might shrink the amount of oil it's going to release coming up in the next quarter or something like that. So that is bullish for the price of oil. If there's less supply, then it's going to go up in price, which I thought, okay, oil companies are going to benefit from that, so the stock could go up a little bit. Sure enough, it did. Also, they won a settlement from Brazil, or I think it was Brazil, some country from 2013. They something happened. I really actually didn't read into it all that much because I had so much to do, but they got this settlement and it was finally coming into them in their favor, and they were owed like $3 billion or whatever it was. So they had a bullish event going on with the price of oil. They had money coming in from a settlement. I thought as this news circulates amongst average traders, this thing could pop a little bit. And I'm not too worried about it because it's got good support right now, being in the oil industry and just having reported and having a decent enough quarter to pump things up. Like, as everything else drops, oil companies are going to be good. Their forecasts are going to be up because oil is still up. Even though it's come down, it's up historically. And that benefits these companies, which is why I went for those weeklies. And I bought the 112s, and look where it closed. It closed like at 112. It was above 112 for a little while. It went up to like 114. I mean, it was more like the 113s for a little while, but it did touch something in 114 and then came back down. And those calls were so profitable, but you had to take them at the right time. I took them a little early. I think it hadn't quite gotten to my strike yet. It was like just about to, and I thought, man, these are up enough to where I'm just going to take them off the table right now since they have such a short time until expiration, which was good because after they peaked, they came down like 40 or 50% before they finally, now maybe not that much, like 30%. They came down about 30% when they finally closed the week. So that was a quick in and out trade, day trade, which I normally don't do. So what do we got here? I played my opinion on oil, ticker VET, long at $13, sold at $22. I'm in it again as of this week. First play was in March. Oh, let's take a look at that real quick, VET. And then actually I got to get out of here, so I'm going to be winding down. Let's go to VET, take a look. You said you were in at $13 and you sold at 22. Man, that's a nice game. Congratulations on that one. Look at that chart. See, this is what I'm talking about. You got a nice long. So where are we talking about here? 13. So you were buying in somewhere in this mess, it looks like, which would have been right at the beginning of the year. And then you dumped it at 22. So probably somewhere on this pump, or did you hold it through all this and dump it later in the year? You said your first trade was in March. Okay, so that's when you dumped it. So you bought it somewhere in here. You dumped it in March. You got a nice profit in that. March 22. Yeah. So that's a wonderful trade, man. Picking that one up right there. And it was a good time because look at this. They reported earnings, and they probably, I haven't looked at VET, but they probably did well enough. And I don't know what they guided, but they're not going to be guiding down as much as other companies are. If they do, they're a lot more supported right now because of the price of the oil and because of the fact that we don't know how long Ukraine's going to last, and we don't know how bad inflation is going to be. Like, you name it. There are so many things propping stocks like this up right now. That was a good trade. I was playing oil a little bit earlier too, but I was focusing more on other stocks at that point in the year. Actually, Snapchat was my big one. Grocery Outlet at the end of last year and Snapchat at the beginning of this year were like two of my biggest trades ever. Those were amazing trades. And the other things I've been doing were trades during the Fed meeting, day trades, which I don't like to do really. So that was a nice trade. Thanks for coming in, by the way, Jukebox88. I appreciate it. I'm doing this every other week, every other Sunday when the futures open at 3 p.m. Pacific time. I'm mostly just going over stuff. This was kind of a different broadcast, but normally what I'm doing is I'm trying to go over all my trades, go over what I think is going to happen with the overall market, and the next meeting, or the next broadcast is going to be right before the Fed meeting. So that's going to be a really important time. That's going to be where I want to save a lot of my cash for. And that's also going to be why I want to be out of things in case stuff gets really volatile around that time. But that's going to be a much more important episode than the one today, because this is mostly just getting ready for everything. We're switching into the final quarter. We're winding down Q3. Earnings are winding down. We're looking at the data for the next Fed meeting, because the Fed is watching the data and they're watching how the market reacts. So right now we're kind of sitting in limbo. We're thinking bull market mode, but not opposed to the fact that bear market is actually still coming in. So let me go back to the SPY real quick so we can end this thing on the SPY. Sure thing. I'll see if I can watch. I'm in Ireland, so odd timing for me, but I trade US hours as much as possible. Hey, that's great. You know what's so funny? The people that have been watching this channel that actually come back are all over in Europe. It's like it's people in the UK, there's some people in the Netherlands, you know, and then you're talking about Ireland. Like, so that's great. You know, I know it's a weird time for you. It's late there. I think the person in the UK was saying it starts at like 12 or 1 or something like that in the morning. So, you know, I know it's a tough time, but I also put these on YouTube afterwards. I have the links down below. I have, you know, all these different social medias that I'm building up, but I edit the streams, you know, get rid of the ums and the ahs and all the stuff that I said that was dumb or wrong or whatever like that. Make it a little bit more cleaned up and then post it on YouTube. Usually takes me a day or two, but I go over all my trades. I go over what I'm thinking. I go over what I think is going to happen with the coming week. And next broadcast is going to be important because of the Fed. I'm also going to trade the Fed live, and that's going to be at about 11 a.m. Pacific time, so that'll probably be a little easier, but it's going to be on a Wednesday. It's going to be on Wednesday the 21st. That I may or may not trade. The last 3 Fed meetings, I've made a day trade, so hopefully I can make another one this time, but I don't necessarily know if I'm going to do it. So I'll be doing that and every other Sunday, and I'm working on other content too, so check it out. Awesome. Thank you for subscribing. I really appreciate that. I'm trying to make more content. I'm trying to build up a few other things too, like a TikTok and a YouTube and all that stuff. And my Discord, I'm building that up a little bit too. I'm trying to post some of what I'm doing, but it's still early and I still have so much going on in life that it's hard to do everything all at once. But yeah, thank you for the sub. I really appreciate it. Thank you for the like. That's awesome. Oh, did you subscribe with Prime? Yes. All right. Thank you. I appreciate that, Jukebox88. Awesome. That's so great. I'm going to try to do this. The more people come, you know, the more I'll do it. I really want to have discussions with people. I want to talk about stocks. In fact, the 23andMe trade that I made, that was probably one of my best trades of the quarter, came from somebody that just randomly came in the channel and reminded me that the stock existed, you know? So like bring the stocks, bring stuff you want to talk about. I mean, there's so much to learn from everybody. I really want to create a community where we can all learn from each other and we can all become better traders, you know, better investors, better everything. So, all right, I need to get out of here. It's getting a little bit late for me. Got a lot to do, but it was a great broadcast. I'm going to be back in 2 weeks. I'm going to be building everything up until then. Hopefully I'll have, number one, an interview with Salome Fishby about cryptocurrency. We talked about Splinterlands. I also have the intro to trading series that I'm building up. The first video should be out in the next couple of weeks on that. And then, of course, we've got the Fed meeting coming up there. So we got a busy week. Stay safe with your money. You know, make sure you feel your trades and your investments. Don't do anything that makes you not be able to sleep at night, right? So make sure that's the way to trade. Like, you'll know if you're trading well if you can sleep okay at night. If you can't, that's probably not the right way to trade. So I'm going to get out of here. Thanks for joining me. I'll see you next week. Have a good weekend and good luck.